that you have joined us. On Tuesday, we explored the future of leadership and learned about how to integrate and iterate upon personal leadership practices for action and accountability. Yesterday, we turned our attention to the future of performance management, and we heard all about the dynamic shifts that are taking place with accounting and reporting frameworks to measure and drive superior holistic value creation. Today, we will focus our conversations on the future of investment, and you will hear about the evolving systems from pioneers who are building new infrastructure to implement mutual financial flow strategies to finance business in this next era of capitalism. My name is Amanda Catherine Roman, and it is truly an honor to serve as your Master of Ceremonies. Now it's my pleasure to welcome my friend and colleague, Bruno Roche, back to the stage to deliver today's opening remarks. Bruno is the founder of Economics of Mutuality, the former chief economist at Mars and head of Catalyst, and that was their internal think tank where EOM began to respond to the question, what should be the right level of profit? Welcome, Bruno.
Well, thank you, Amanda, and welcome to you all. Good morning, good evening, good night, whatever time zone you are in. And it's my pleasure actually to start welcoming you with a few minutes of introduction. So the overall horizon for business and investors is that the externalities of yesterday are the risks of today and the losses of tomorrow. And by externalities, we mean all the positive and negative impacts that business have created in society and the environment. And how business leaders and investors will respond to this question today will eventually define the value creation processes of tomorrow. It will not only define whether you will have a business or not, it will actually be the reason why your business exists. So it's no longer a secondary question. It's no longer a question that you may ask to yourself on the Friday afternoon. It has become over the last few years actually the reason of being, the real purpose of business. And I like to quote here Nobel laureate in economics Joseph Stiglitz, who said a very interesting quote a few years ago. He said, like the dieter who would rather do anything to lose weight than actually eat less, this business elite would save the world through social impact investing, entrepreneurship, sustainable capitalism, philanthrocapitalism, artificial intelligence, market-driven solutions. They would fund 1 million of these buzzworthy programs rather than fundamentally question the rule of the game or even alter their own behavior to reduce the harm of the existing distorted, inefficient, and unfair rules. So the fundamental question that Joseph Stiglitz is referring to is what should be the right level of profit, which in turn is changing fundamentally the purpose of business. And just as the laws of war were reformed in the 19th century with the Red Cross to alleviate the suffering of humanity, the laws of profit must also be rewritten so that creation would stop groaning and humanity would reinvent the path that leads to common prosperity. Therefore, the purpose of business, as we said several times over the last couple of days, is no longer about maximizing profit. Profit remains an important objective of business, but it is a secondary objective. It's no longer doing less harm while continuing to profit. It's really about profiting from creating solutions to the world problems. This is the new frontier for business and investors. So over the last couple of days, we've been listening to business leaders sharing where they are on their purpose journey. Some of them are early in that journey, some of them are more advanced. But in the end, it's a bit like the story of the laborers of the 11th hours, where the workers who have worked for 1 hour earn equal rewards than the ones who have worked for a full day. So there is no need to be jealous of the later converts. It is the opposite. Again, here, the key message is that there is no difficult point to start. There is no difficult road to go through. The beauty in the end is in the journey. But what is clear is that, number one, the time for charity is over. So the idea that you can make money one way through a maximization profit model and spend it the other way through setting up a foundation, for instance, this model is not only outdated, but it is also inefficient. You know, there is this famous quote that charity dollar only has one life, whereas business dollars have multiple lives. It is also morally questionable. I remember Wendell Berry, the American poet, novelist, and farmer, who we met at the very early stage of the economics mobility program, shared with us this country, and he was talking about the US, is actually truffled with foundations, but behind each one of them, there is a guilt conscience. So what is clear also, that's my second point, that the time for CSR and ESG is also going to an end. The idea that you can keep your business model as is and run a series of peripheral activities that are good for the planet and good for society, with the ultimate goal to just mitigate the risk and protect your reputation, this model is also insufficient. It is undermining trust in business and paves the ways to what is called a sustainability Ponzi scheme, in which organizations make commitments and hide their inability to achieve them behind making even more far-reaching new commitments. Or said differently, it's greenwashing, purpose washing, rainbow SDG washing. And you know, today, only 35% of the public believe that business leaders tell the truth. Only 38% actually believe business is doing well or very well at putting people before profit. So this is a quite astonishing figure that actually business has actually lost trust in society. So there is no other solution than to embrace this purpose revolution. And our argument is that this purpose revolution is underway. Nothing can stop it. It is as important than the digital revolution. Companies that will succeed at transforming their business with purpose at the core and with purpose at the core to drive strategy will thrive. The others that do not do this kind of exercise will decay and eventually die. And the critical reason why is because, you see, economics, as we said several times in our discourse, is that economics is ultimately about managing scarcities. And scarcities have changed dramatically over the last 50 years. 50 years ago, financial capital was scarce and natural resources were overly abundant. Today, it is just the opposite. So it is not being ideological to say that eventually the economic model will address the new form of scarcities that we are facing collectively. And the second point, which is as important as the first one, is that over the same 50 years, companies, in particular, large multinational corporations have increased tremendously in size and in influence, and they are eventually the ultimate actors to move the economy from managing financial capital scarcity to managing other forms of scarcities. And also, I mean, the good news is that we're starting to have some interesting research, which is backed by data and longitudinal studies. There was a paper actually written by George Serafeim a couple of years ago, which showed actually that purpose-driven companies outperform the S&P 500 companies by a factor of 24%. So putting purpose at the core and putting purpose in practice is actually a good business practice. The second reason is that regulation is on the way. The new EU regulation, and I pick here the EU because it's one of the most advanced region when it comes to regulation on this particular topic. The new EU regulation will impact about 50,000 companies by 2024, representing about 50% of the GDP of the largest economy of the world. And all companies, listed or not, employing more than 250 employees will be concerned. And it will require the reporting on the full range of sustainability information relevant to the company's business, and that reporting must be in line with mandatory EU sustainability reporting standards that will be developed by the EU Commission. And this will require that the sustainability information will be subject to a limited level of audit insurance. The fourth element is that this new generation of business leaders in management schools is actually internalizing these issues. Today, we have about 91% of business leaders that believe that their company has now a responsibility to act on ESG issues. And lastly, civil society is no longer accepting a system that only works for a few at the expense of all the others and the planet. Today, only 20% of the population believe the system is working for them. And 83% of consumers think companies should be actively shaping ESG best practices, and 86% of employees prefer to support or work for companies that care about the same issues as they do. So this is my last point. We are facing here a systemic change that requires a systemic approach based on 5 pillars. The first pillar is really about a complete turnaround of the management education to recover what we call the power of criticism with regards to the human inventions opposed to ethics. And finance, actually, over the last 20, 30 years, has become an invention, a human invention opposed to ethics. And the purpose of management education is to recover the power of criticism with regard to this kind of human invention opposed to ethics. The second one is the emergence of courageous leaders who have the moral energy to rewrite the laws of profits and implement them in their organization so that creation would stop growing and humanity would reinvent the paths that lead to common prosperity. The third pillar is a new practice of finance, and that's the theme of today. A new practice of finance that will be superior to banking and wealth management to reposition finance as a tool to facilitate resource exchanges versus becoming the goal of economic exchanges. The fourth pillar, and we mentioned it a bit before, is a new set of regulation that will enforce economic actors to play by certain rules to protect the common good. That the market mechanism cannot guarantee. You know, there is this expression that actually has been used several times in history, like purely free market is like a free fox in a free hen house where the chickens are free. The fifth element, it's more like a calling for a new generation of artists that would be able to communicate what we just discussed now and create a sense of urgency, responsibility, but also of hope. So these are the 5 pillars: education, business implementation, investment, regulation, and the arts. So today, we are focusing on the role of investment to accelerate the next era of capitalism. It's a critical pillar that has the potential to pivot the whole system. Some figures show that the investment world is gradually moving into that space of responsible investment. For instance, the share of ESG investing will reach $53 trillion by 2025 and will represent a third of global assets under management and also about 50% of the global GDP. It is true today that Europe is accounting for about half of the global ESG, but the next wave is coming very quickly, first from the US, but also from Asia. So that space will continue to grow. That space will continue to self-organize. That space will continue to be regulated. And that space will continue actually to be in service of the transition from an economy that has been profiting from creating problems to an economy that is profiting from creating solutions. So it's my pleasure to introduce now the next session, which will be a fire chat between Colin Mayer and Hiromichi. Colin has been a long-term friend and colleague on this issue. We had a chance to co-author a number of papers and a book. We also had a chance to work on his journey over the last 7-8 years. It's been a real pleasure, Colin, to work with you alongside with Oxford University that you represent. And it's also my pleasure to introduce Mizuno, who is on the board of a Principle for Responsible Investment Association, and is also a UN Special Envoy on Innovative Finance and Sustainable Investment. Welcome, Colin. Welcome, Hiro, and I look forward to hearing your fire chat.
Bruno, thank you very much indeed for that inspiring introduction to the subject of today, which, as you say, is all about investment and finance. And Hiro, it's wonderful to have you with us. Thank you very much for taking the time to be here. And I'd really like to begin, if I may, Hiro, by just picking up on a topic that I know you've been a phenomenal advocate of for many years and have done an immense amount to drive forward around the world. And that is ESG investing, environmental, social, and governance investing. Perhaps you can just begin by telling us a little bit about why you think it's so important and whether you feel it's happening at a sufficient scale to really bring about the changes that are necessary. Hiro.
Sure, Colin. Thank you for having me. It's my real pleasure to join this discussion. I think the yourself and Oxford has been driving this agenda. I have been advocating throughout my time when I was managing the Japanese government pension fund, and even after I left, importance of the academic, approach to prove these like ESG is just not the philosophical things, but the more financial and the more logical and the more commercial implication related to what the ESG can bring to the table of the investors as well as the corporate executives. So let me just start with how I came across with the ESG for the first time. When I became an investment chief of the Government Pension Investment Fund, GPIF, the world's largest pension fund, in 2015, first thing I did was really trying to analyze from the scratch that I can manage this $1.5 trillion portfolio over long term to contribute to the sustainability of the Japanese public pension scheme. And then, I grew up in industry, learning how to actively manage, passively managing, and also doing bond, equity, private, and public. But the first thing I had to do is I really need to challenge the older sort of like a conventional wisdom I studied at the finance course at the MBA, as well as the preparing for the chief certified financial analyst, as well as the older on-the-job training. And after the several months of the contemplation and also the analysis, I came to my conclusion, which was, regardless of all the different investment approach, investment in the portfolio approaches, if you look at the long-term performance of the big asset owner, they have a very strong correlation to the whole economy or macroeconomy or global economy. So for shorter term, you can make a difference by skewing your portfolio, or the investing into more private or more bond or etc. But if you look at the long term, basically a big asset owner, they own the universal capital market. In other words, own the global economy. So without making the global economy more sustainable, the portfolio of GPF will not be sustainable, regardless of what we do as a financial professional or investment professional. So that's why I just started thinking about what can we do using a power of capital to make the whole system more sustainable. But that concept at that time was very difficult to convey. Today we're going to discuss about that in maybe after the getting into our discussion. But a lot of people actually called me you are a religious leader. So some people in 2015 thought the ESG is more religious than the financial. But I actually need to come up with some tools to use to promote the idea of the systemic sustainability, or the universal ownership approach, because the GPF is the owner of the capital market universe. So that kind of a concept I need to convey throughout my own team and throughout the industry. And ESG was the one which was already available at that time, and carries more sort of like a more concrete, the sense of the financial implication. Although it was not very well proven by academic research or backed by academic study, but that was the most concrete one at that time. Ever since everybody started talking about ESG, and according to GISA, now the total amount of money either invested into the ESG themed fund or do any type of ESG integrations, the ranging from divestment to ESG integration, now add up to the almost like a $40 trillion. And that increased the 18% over the last 2 years. So it shows on the top line number, it became obvious it's becoming more mainstream in the finance or asset management industry. But I think so now we just don't need to follow the top line of how much money they claim they are in ESG integrated, but probably we are now have to focus on what it really means, or how much of that the aggregate amount is really making the difference in the way they invest. So, even if you use the ESG for analysis, if you don't change your investment decision, it doesn't mean much. So I think the now time for us to really reflect. When we have gone a long way to make ESG mainstream, but now we have to think about the quality of ESG integration, whether it's really making a difference.
Do you think there's a risk that it could all topple over and be discredited?
Well, I think we are actually on the verge of either succeeding or failing, in my opinion, because first the people need to agree this is what we are trying to achieve, what we are trying to do, and then you get into the get onto the stage where whether you can prove that with actually action. And then you have to back, the show that your action turned out to be a right decision from financial perspective, as well as all the different perspectives. So it's I always say we can now say ESG is a mainstream, but it's still too early for us to say that whether it's really changed the how the capital market price the investment and how the capital market really reallocate the capital between different businesses in different regions.
There's a lot of attempts going on at the moment to standardize the way in which ESG funds and reporting, non-financial reporting, is undertaken. Do you think that's moving in the right direction? Do you think there's more that should be done?
Yes, I've been advocating like a standardization or like a need for the standardized ESG matrix for two reasons. One, a lot of people just use the lack of the standardized information disclosure as an excuse not to really take an action. So we just need to take an excuse away from those type of people. And I must say, like quite still very high number of the investment professional, including asset manager, just sitting on the fence saying like we cannot do much without the standardized the disclosure matrix. But I think they are using that as simply an excuse. So we need a bit of better standardization to take that excuse away from those people who trying to sit on the fence or enjoying status quo. And the second is there also some people who are really wanted to start using the ESG information or ESG factors for their investment analysis are also decision making, and those people has been calling for and almost crying for the comparable information sets. And then those people obviously, as soon as they get the such a satisfactory standard, I mean they will shift the money. So I think if we succeed in the creating widely accepted standard, that will move the market. So I think it's going to be a game changer. But on the other hand, I always say like even without the standard or like a comparable information, a lot of people want to go into private equity market because they think that kind of lack of the comparable data actually give the opportunity for the investor to make the extraordinary return. So I think the nature of the financial professional and also the professional investors, once they started seeing it's coming, they probably try to move before it arrives. So I think all the effort, including like a European taxonomy, or like a IFRS, the new the foundation of the ISSB, which was announced at the Glasgow COP26, is going to push the market. And depend upon why you are not taking action right now, as I just gave some possible potential reasons for them not taking action, I think they will start moving. And maybe the timing of the actual change in their action may differ from depending upon their real reason. But I think we are going in the right direction. And I'm hoping that particularly IFRS, ISFP can come up with their the guideline as quickly as possible on the climate, because we are running out of time to solve it.
Does it worry you that there might be inconsistencies between what, for example, the EU and the IFRS are doing, or do you think it doesn't really matter?
Honestly speaking, even now, I mean, the US GAAP and the IFRS are not particularly, the compatible in many aspects. So, as far as they are within the reasonable, the range, even if there's some like a discrepancy, I think the market will start using it. And sometimes the market may use it to make an arbitrage opportunity too. So I'm less worried, but I'm more worried about the discrepancy if that slows down the establishment of the new standard. So the one thing I liked, and also I advised to the IFRS, the leadership team was, please don't try to make things from scratch. There are so many efforts being made over the last decade, trying to set the ESG disclosure standard. So rather than trying to test the build it from scratch, trying to leverage what they have they already managed to come up with. So for example, like a climate change, they already made an announcement that they are going to use the TCFD framework and bring in some other, the standard, the possible standards, the set by the other institutions. So I think if the discrepancy ended up in, the delay, I'll be concerned. But if they can come up with the standard within the reasonably quick time frame, the minor differences, I think the investor wouldn't care.
Now, in Glasgow at COP26, Mark Carney came out with some quite dramatic statements about net zero targets of asset management businesses, talking about over $100 trillion worth shifting in that direction. Do you think that's realistic and achievable? Do you think there are ways of ensuring it's going to be achievable?
Well, I'm his peer special envoy, and I helped him to put the alliance together. Well, I think one of the expectation I had from that G fund, what they call it, the Glasgow Financial Alliance for Net Zero, was over the last years, every time I talked about discuss with the asset manager or the peer asset owner about the climate change, how that the climate change or the Paris Agreement should be integrated or interpreted into the today's portfolio management or portfolio construction, the biggest struggle was nobody really believed in even a 2-degree scenario should be used as their base case scenario. Because, when you make financial analysis, you need to have a base case scenario, right? So if you just cannot believe in a 2.0 degree transition, we're not going to happen. It's very hard for the people to reflect that into their portfolio management. So this time they are agreeing like even more ambitiously, like they are now saying we are committing to 1.5 degree or net zero in 2050. And if 450 financial institutions says this is going to be our base case, so this is the trajectory we are going to compare our investment, I think that will give the sort of the big, the tailwind for the acceleration of the capital market towards the Paris Agreement alignment. So I think that's the biggest achievement of the G funds, because now everybody should think like, oh, if these guys are saying like a 1.5 degree or like a net zero, we should use it as a base case scenario for analysis. But on the other hand, he always say like a $130 trillion are already here ready for climate, the action of climate finance, which is a bit probably overstatement, because that's just the aggregate amount of the AUMs of all those financial institutions, right? It doesn't mean it's set aside for the climate action of climate finance. And the most inconvenient truth of that number is, whatever number you use, the UN always use like, we need the $1.5 trillion every year needed to just achieve like the sustainable energy transition. And then issue is 2/3 of that money have to go into developing countries.
Yeah.
But out of that, the $130 trillion, as far as I know, it's less than 10% is allocated to developing countries. So, even if that's a big number, if we don't have the enough allocation for developing countries, we are not going to finance the energy transition or like a sustainable transition. So I think that's the probably most inconvenient truth of that number. But having said that, I always think like, people actually ask me like whether I think the COP26 was a success or failure. And I always answer saying like, it's too early for me to say.
Right.
Because if the financial institution come up with the action plan to, really deliver their promise, we will call the G funds a great success. Sure. But if they don't come up with the actual action plans, which they haven't come up with yet, we probably call it like a greatest greenwashing alliance in history. So we just need to make sure that the older institution who made that commitment will come up with the action plan over the next 12 months.
The point you just made about flows into the developing countries is an incredibly important one. Do you think that there are ways that one can do to encourage that, or is it really difficult to achieve?
Well, it's very difficult to achieve unless the older players in the financial market work together, because the one of the things which haven't been able to achieve by the time of the Glasgow at the G funds was it's the alliance of the alliances. So everybody made a commitment in their own silo. But I always say, when the asset manager, the commit to net zero, I always wonder how they could possibly achieve it when most of their money is linked to the index. So without index becoming Paris aligned index or like a sustainable or green index, I mean, asset manager cannot do much. I mean, not talking only about the passive, but even active managers, their performance is benchmarked to the passive index, right? So without changing the composition of the indices, it's very hard for the asset managers to make their portfolio net zero. And then also to shift the money to the developing countries, we just need to ask the credit rating agency to expand their rating universe, because many of those countries who really requires the funding for their energy transition, their bonds are either not rated or rated too low. So it's very hard for any investor to shift the money into to those regions. So we just need to make sure credit rating agencies will take the sustainability aspect or ESG aspect into their rating of some specific project. So what I'm trying to say is, without having all work together, I forgot the one more, clear example, which is asset manager always says, "Oh, we are just an agent, right? We cannot change our portfolio without our principal tell us to do, which we are asset owners or retail investors." So none of those players can achieve their commitment without having the other player change their way of doing business. So I think now we have to really sit down and just kind of talk to each other and demand each other to change their practices. And the financial market is so interdependent on the other, other players in the market. So I think that's going to be the real challenge. And I think that should be the ultimate goal of the G funds, so that where each different players can really tell the other player to do their role, their job, so that they can do their job. So I think that's an important point, and it has been missing still.
I'd like to now just turn to what is really the focus of the forum, and that is on the notion of corporate purpose and the role of purpose in business. Now, some people equate ESG and corporate purpose. Do you think they're basically the same thing?
Well, I think the ESG was developed as the sort of financial materiality, or a financial tools. So it started as a vocabulary for the investors, as the PRI, the organization who established the concept of ESG. But these days, it changed, it's used almost interchangeably as the sort of a corporate purpose, stakeholder, capitalism, and sometimes SDGs. And when I hear that, I don't intervene, because basically they are talking something in the same domain. But as I said earlier, that the ESG is the one for investors. That's how it's developed. And corporate purpose is more like how the business should be run. So I think that's the kind of a difference between those two. But what I had been advocating was, corporate purpose is basically another way of describing multi-stakeholder capitalism, right? So the company cannot just only focus on maximizing shareholders' value or paying more dividend. They need to pay attention to other stakeholders, and the company can interpret those a multi-stakeholder model into their purpose, because most of the corporate purpose, if you read it, basically they are talking about the non-shareholders, the benefit or importance of non-shareholders' value. So, and also the other thing the purpose usually described is kind of a sense of long-termism. So I always think a corporate purpose or the purpose-driven businesses, they are basically talking about, we care all the stakeholders, including shareholders, but all the other stakeholders as well, and we always have a long-term perspective. That's the basically what the corporate purpose is going to talking about. And ESG, from the investor's perspective, we just cannot say oh, we wanted to invest into the corporate purpose, right? So but we can possibly say we are going to invest in the the ESG factors, or we are going to integrate the material ESG factors in our investment analysis and decision making, and those are usually related to what the corporate purpose want to describe. So the SDG is the same. I always say the company probably should use a purposes or SDGs for the company, or a corporate executive to describe what they are trying to achieve. But it's much harder for the financial, the institution financial professional to use those for their financial analysis. So I recommend them to use ESG. So it's not the perfectly, matching, but I think directionally they are talking about the same thing from the different, different side of the table.
Right. Now, one of the problems that we've had for a long period in this area is a lack of engagement on the part of institutional investors in really engaging with companies and stewarding their investments. And one hears a lot of frustration from companies when they're talking about corporate purpose that they're not really getting the interest they would like from investors. Do you think there are things that can be done to address that issue and improve the
Well, I
engagement?
think the efforts are needed on the both sides, in my opinion. So as I said, it's hard for the financial analysts to really use the purpose in their valuation model. So I think the CFO or CEO or even IR person who talk to the investors or the financial analysts, stock analysts, they need to interpret their corporate purpose in the framework of like ESG. So that's the effort I think the needed on the corporate side, and for the investors side, I have been very disappointed many times. Like the investor who talks about ESG all the time, but they don't ask the question about ESG when they meet the CEO. They only ask about what's the next quarter, what's your pipeline, those kind of things. So I think it's also the mutual. I recommend the corporate executive when they sit down with the investor or financial analyst, ask them which the ESG factors you think is very critical, relevant for your valuation of our business. And trying to talk on that, because I think the most of the meeting I even participated, they talk about the short term, like a next quarter predictions, and they run out of time. So my suggestion to the corporate side is ask the investor, so which ESG issues you want to hear from us, right? So but in that kind of dialogue, using ESG as the common vocabulary will improve the efficiency of the dialogue. It's very hard to bring the corporate purpose in that kind of in that context.
Do you think that the rise of what you were describing earlier on as these global funds, the index funds, passive funds, do you think that's undermined the type of engagement by investors that we're needing, or do you think it's been helpful?
Well, it has undermined in for a long time, and I really trying to change it when I was at the GPIF. So historically, like what the investor or clients expected out of the passive fund manager or index fund manager was lowest fee and the lowest tracking error. But we need to change that. So the when I was at GPIF, I told the passive managers, like that we expect you to obviously deliver both, but we expect you to step up as the active owner. So the passive management means you have to track the index passively, but it doesn't mean like you have to be a passive owner. So and another inconvenient truth of the truth here is, for GPI, for example, almost 80% of the portfolio is managed passively. So the lion's share of our GPIF's voting power resided in the passive side of the portfolio. So active manager who engage more actively with their portfolio company, and they trying to show their will or their their judgment by exercising their voting power in particular way. But unfortunately, only 20% of voting power reside with the active managers. So without having the passive manager to act responsibly or as a steward of the investor, obviously, but the have to be active owner. So I try to say that very clear to the passive manager. We demand you to manage the portfolio passively, but we expect you to become an active owner of our portfolio. So that's not the contradicting to each other, but the probably we are the first one who raised it, and the GPEF even offered extra fee to the passive manager who came up with the KPI on which company they wanted to engage on which topic, and also the time frame. If they can put it, in advance with GPIF, we offered extra layer of fee. But I think the passive portfolio, the index investment, if their clients don't change their way to or their demand out of passive manager, I think increasing the passive portfolio will undermine the shareholders' activism. But if the investor started holding the passive manager accountable for how they act as an owner, I think that will be a game changer. And I think these days, the BlackRock and the Vanguard and the State Street, they have been increasing the number of the people working in their stewardship team and engagement team. And the Vanguard recently, I saw their report, the Vanguard and the universal ownership. So I think they are now getting it. But I think all the clients of the index fund have to raise that. They expect, they have to tell their passive manager, we expect you to be more active and more responsible owner. So I think that's going either direction. It can undermine, it can promote, depend upon what kind of expectation you can set with the passive manager.
Now, one type of active owner or active investor, rather, that we've observed recently is, of course, the activist funds. Do you welcome the arrival of activist funds, or do you think that they're...
Well, I have several personal experience, the mostly negative dealing with the activist fund, but I think, shareholders activism and the activist fund is, people sometimes confuse, but very different. So I think the things like a Climate Action 100 Plus, that's the biggest alliance of the asset owner jointly engaging the company to transform their business model to the more sustainable energy based business model. I think those are more like the shareholders activism, and activist is something like they come into the company with some different incentive or motivation. But as we observed that the sort of like a collaboration between the big asset owner and the hedge funds, activist fund, or actually they are hedge fund in the US to challenge ExxonMobil. So that kind of things is possible. But I think what really divides kind of the activism, which actually hinder our the promotion of long-termism or sustainable capital market, is that how short-term oriented their goal is. So I think the reason why the CalPERS and the CalSTRS decided to support engine number one on the case of ExxonMobil, well, they kind of agree that they have long enough and the plan how to engage with the company, rather than coming into the company and strip the business and trying to increase, pay out the dividend. That kind of things is not the CalPERS, CalSTRS would have supported. So I think it's hard to, we probably shouldn't sort of like categorize like, activists is this, do this, but it's more about the, all the investors becoming more active. And if the activists can align their interests with the sort of long-term investor like pension funds, I think the collaboration between those will become more common. But so far, I mean, in many cases, you probably ended up seeing like they came in with a very short-term incentive and a motivation, which doesn't necessarily contribute to the sustainable transition of the business. So I think you just need to see kind of like a case by case. And I always say, like, one thing is funny is I always said I never met the activists who want to be called activist. So activists carry such a the negative perception. So they probably need to change their. I mean, these days some of them call themselves deep engagement fund or deep engagement managers. So I think there's a spectrum between like the long-term active ownership or shareholders activism and the short-term, like very short-term oriented activist.
Well, one of the phenomena that we've observed recently has obviously been the growth of private equity markets and the shift of some public to private equity. Do you think this is a good development? Do you think it reflects a better form of governance by the private than the public sector?
Well, I mean, before I joined the GPIF, I was a partner of private equity fund. So I did, the private and public sector investment asset management. And one of the struggle of managing the public company, particularly align their business with the long-term goal, is that there's all the different type of shareholders existing in the public market. Right, so it's very hard to have a kind of like a consensus among the shareholders. What the and so when we try to persuade the CEO to deal with the climate change or gender diversity and etc., and even when they make a right announcement, the market doesn't treat them well always. And you probably saw that. I serve on the mission committee of Danone, and at Danone we saw a lot of them. Like they made a lot of like a good announcement, trying to just reshape their business in line with the new the climate goals as well as all the other KPIs on the ESG. But some activists really was aggressively attacking the management, and also the public market didn't support that kind of decision, which is a good decision from the ESG perspective. So I think the managing public company is very hard, and where I think the role of governance or role of board is very critical. They need to be the one to make sure that the CEO can also the focus on long-term agenda. But the private equity, you don't have that problem, right? Because you basically have only one shareholders. So as far as you can agree with the shareholders or like private equity fund, you can actually focus on the delivering, that commitment. So there's it's much more efficient in terms of governance, particularly addressing long-term agenda. But on the other hand, the private equity fund has a fund life. So they need to just liquidate their holding. So I cannot say like which is better or which is worse, but both has their own challenges. But what is very important is now reflecting significance of the private market. We just cannot afford the private equity fund. We cannot afford the private equity fund neglect or ignore ESG in their the businesses they own. So I have been advocating throughout the spectrum of investment, from the venture capital to the private equity, public equity, and the bond investors. Everybody have to integrate ESG, and then we can optimize whole market system.
Well, one final question, if I may, Hiro. If you come back to the Responsible Business Forum in 2026 or 2031, what might you hope or expect to see as the investment landscape then?
Well, first of all, 2031, I think that we just need to have the confidence in our portfolio is aligned with the Paris Agreement or 1.5 degree, because 2030, this 10 years is the kind of, according to the scientists, critical 10 years. So if we don't see in 2030 the pathway is already getting aligned, we are in a mess. And the other thing is, this is what I suggested at the the 10th anniversary of PRI, trying to set the next 10-year goal, which is meant to be like a 2030-ish. I suggested that the ultimate goal is nobody will be talking about ESG anymore, because once the market has fully integrated, we really don't need to have the sort of like to talk about the ESG this much. So what I'm hoping is 2030, everybody take it for granted. All the investments, nobody debate whether we should use PER or PBR or those kind of things, like the operating margin, those kind of things. Nobody argue or nobody debate whether it's necessary. So in 2030, I'm hoping people not going to discuss the whether ESG factors are important, and it should be, it can be fully integrated by then. And the other thing is, we need to achieve all the goals of sustainable development goals, but I'm aware that something we can probably achieve quicker. The other goal, it takes longer time. So 2030, we sit down again and we give our own scorecard, which SDGs we have achieved and which we failed, and hopefully that we have a roadmap from there to quickly solve it. Because I'm still hopeful we achieve most of them by 2030, but we're probably going to leave some unsolved by then, and that we should have the clear roadmap in 2030. Otherwise, again, we'll be in a big mess.
Hiro Mizuno, thank you very much indeed for an absolutely wonderful discussion. Thank you.
Thank you, Colin. Thank you for having me.
Thank you so much. That was a fascinating conversation. Lots of conversation between the participants in the comment section. So thank you for joining us, Hiro and Colin. Next up, I'd like to welcome Nadia Terfous to the stage. She is going to be leading our panel discussion on the future of investment. And Nadia is the Managing Director of Economics of Mutuality Solutions. Before joining the platform, she worked for more than 17 years in the areas of business and economics. She spent 14 years with McKinsey & Company, the leading management consulting firm, where she acted as a partner for 5 years. She's advised public and private sector customers and clients globally, and she has focused on Europe, the Middle East, and North and West Africa, on topics ranging from everything from strategic changes to economic development plans and organizational transformations. And finally, she worked 3 years at the French Ministry of Economic and Finance as an economist within the Treasury Department. Welcome, Nadia.
Thank you very much, Amanda. Welcome to the Future of Investment panel. Before introducing our wonderful panelists, I would like to give you some element of context on our topic, which I believe is core to the question of building the next era of capitalism, because it can really help drive changes in the way financial capital gets allocated, non-financial capital gets remunerated, and in the way the overall economic system operates. Like Bruno, Colin, and Hiro actually reminded us, current numbers and growth in ESG or sustainable or responsible investing are quite impressive. They have become basically mainstream. Today, we estimate that about $40 trillion investment from institutional investors have some sort of ESG lens, which is about a third of the global assets under management. So the question is, what does that mean? Like Hiro actually pointed out. I think there are 4 main strategies in terms of ESG. The first one is the negative screening and the exclusion of companies, sectors, countries based on ESG criteria or international norms from international organizations, NGOs, or, for example, the issue being, as you can imagine, that some sectors are still needed today. and that we are not really preparing the transition by throwing the garbage in the neighbor garden. I'm using an expression that I heard recently, which I think is a good one. The second strategy is the proactive consideration of ESG factors in decision making, like investing in certain industries that aim at solving global challenges or investing in companies with high ESG score. The issue here is that, as you know, there are 600 different ratings and rankings of ESG performance with very different results. And in the first place, the quality of the data is rather poor. Also, ESG tends to be related to internal processes and focus on doing less harm, while organizational purpose, as also it was discussed in the previous interview of Hiro by Colin, organizational purpose actually, on the contrary, focuses more on real outcome for people and planet. The third strategy is engagement and stewardship, so playing an active investor role through, for example, voting at shareholders' meeting, engaging the board on critical topics. And you have heard Hiro and Colin talk about the activist funds, which are shaking large corporations in spite of very tiny shareholding. And the last one is impact investing, the fourth one, which often concedes some returns to generate impact for people and planet. So the question is, are we moving in the right direction with all this ESG investing, or are we just massively greenwashing and delaying overdue systemic solutions? Could we also find a path where we could connect financial performance and investment in non-financial forms of capital, which is at the core of the economics of mutuality's ways of thinking? So let me now turn to our impressive set of panelists. So I'll start with Sarah Keohane Williamson. Sarah, after a few years with McKinsey & Company, you joined Williamson Management, an investment advisor working with more than 2,000 institutions in the world and managing more than $1 trillion in assets. You became a partner there and stayed 22 years in total. You've been since 2016 the CEO of FCLT, a not-for-profit organization dedicated to developing practical tools and approaches that encourage long-term behaviors in business and investment decision-making. Welcome, Sarah.
Nadia, thank you so much.
Can I ask you, Sarah, to describe in your own words the purpose of FCLT?
Sure. So FCLT stands for Focusing Capital on the Long Term. And our mission is to do that, to focus capital on the long term, to support a sustainable and prosperous economy. And so what we do is we're a nonprofit. We do research and collaboration around how do we make the capital markets do what they're supposed to do, which is really provide that connection point from people who have capital to deploy to people who have ideas, which should benefit all stakeholders.
Thank you and welcome again. SandraLawson, you started your career at the CIA at the China desk. You spent 24 years with Goldman Sachs in different positions, including MD and Executive Director of the Global Markets Institute, the research think tank within Goldman Sachs. You joined recently BlackRock, the largest asset manager in the world, with close to $10 trillion in assets under management. And you are the MD of Stakeholder Capitalism. Welcome, Sarah. Can I also ask you the same question for BlackRock? Sandra, sorry. I said Sarah. Sorry, Sandra. Sandra, we don't hear you. I think you're muted.
Okay, is that better?
Yeah, it's better.
Yeah. Apologies. Thank you for having me, and thank you for also what's a really easy first question, in that about 2 years ago, BlackRock decided to develop a narrative statement of purpose. And now it's on the TV monitors, it's on the screens as your screensaver, it's impossible to escape. So I can say very confidently that our purpose is to help more and more people achieve financial well-being. And while I think you typically think of this in the context of retirement, and that is a huge part of our business, it's also much more. We want to democratize access to financial markets, to make them easier to access, cheaper to access, to innovate products so that really there's something for everybody. And we take a long-term perspective because we think that that is what actually creates the most value for our clients.
Thank you, Sandra. GavinLong, you have 20 plus years of experience in corporate finance and transaction. You also have a very strong experience in providing tech solutions to government and business clients. You worked for Imperial Capital and Arthur Andersen, among others, and you co-founded the Acacia Group, a PE investor group backed by ultra high net worth US families. And you are a partner at Acacia. You also acted as a CEO for 2 of the portfolio companies of Acacia. Gavin, welcome. Can I also ask you the same question for Acacia?
Yes, thanks, Nadia, and it's good to see all of you actually again. Acacia is really committed to rethinking how private equity in particular redeploys capital or deploys capital. And thinking about using human capital, social capital, natural capital, drivers, metrics to really think about how we create outsized financial returns. We're really committed to the idea that an economics of mutuality philosophy does not sacrifice financial returns or financial gains, but taking a longer term investment horizon like Sarah is advocating and like Euro was talking about in the previous panel, we believe is critical to changing the way capital is deployed.
It would be interesting, Gavin, to hear your thoughts also, because Euro was mentioning that from a government's perspective, it's easier in the PE, but there might be the horizon issue. So it would be great to hear your thoughts on that.
Yeah, I don't want to sidetrack us because I know we have lots of things to say, but I did find that extraordinarily exciting what Hiro was talking about. And I would say we believe at Acacia there's actually some emerging trends in private equity that actually allow for a better alignment of LPs, the passive investors, the institutional investors, a longer term commitment to these transformational ideas. But we think there are fund structures that actually allow for those limited term charters to be not inhibiting some of the transformational change. And we think there are some direct institutional investors, their family offices, and that are committed to this transformative approach to deploying capital. And that alignment of LPs and that long-term commitment and that lack of inhibition on the term, we think that's a critical component to realizing this transformative approach.
Thank you, Gavin. And I think we'll for sure talk about that. I think it's really important to understand how that can work. So I've given a very I would say high level overview of the investment institutional investment space. And as I said, I think ESG means a lot of things for a lot of different people. So it's getting a little bit confusing. So can I ask a question around, so are we actually really moving the needle? And do we see in this ESG space differences in terms of investment classes, by type of investors, by geography, both in terms of the share of investment, but also what that really means across these different aspects? And maybe Sarah, if you want to get us started on that.
Thank you. And and Gavin, and to the conversation before about long-term investing, that is clearly where we think you have to start. There's no such thing as short-term sustainability. That's an oxymoron. So in terms of the different kinds of investors, I mean, the way that we see it, at least, is that there are many different kinds of investors in the capital markets. There are indexed investors, there are active investors, there are private equity investors, there are other sorts of financial intermediaries such as banks, insurers, others, and each one of them them is thinking about what their responsibilities are much more broadly, I think, than they have in the past, and thinking about how do they really tackle those and put them into their investment processes. And they will have very different answers. And as we know, and Hiro mentioned this before, business asset managers are usually managing somebody else's money. It's not their money. So how they do that is a little bit tricky. But the way that I think about it is that each one of these kinds of managers or investors has a different set of tools, and they can use those tools. So for example, an index manager, and Sandra could talk to this, tends to have a lot of votes. So they can use their votes. Whereas an active manager can vote with their feet. They just sell the stock if they think that somebody is doing the wrong thing. A private equity manager typically can control the company or control its board. And an insurer or a banker can decide who they're going to do business with. And even a retail investor can decide what they own. They can turn up at AGMs if they want to, and they can write letters and so on. So the way that I think this has changed is this idea that only very, very large investors can be to have any ways to influence is not the case. Every different kind of investor, private, public, active, index, whatever it may be, has a set of tools. The critical thing is understanding which tools one has and then deciding what responsibilities you're going to deploy those tools against.
Thank you, Sarah. And I think, and I will let Sandra and Gavin react to what you said, but I guess there's also probably a question at some point around, can we let the investment world decide for what society should look like? So there's probably a question of what are the guardrails, or what are, the rules that we want to put in place for investment to act also on behalf of society somehow. Sandra, Gavin, do you want to react?
Sure. I would just say, let's put the conversation about how we organize the governance of large investors on the side just for the moment. I think Sarah gave a great overview of this, and I just wanted to flag there's a real challenge, I think, for the asset management industry in that people don't really know what they're getting necessarily. What is ESG? What is sustainability? What is impact investing? What are you getting? What are you giving up? We talk about this a lot here in the context of our ESG investments are under the sustainable banner. But if you think of like a tobacco company that might have excellent corporate governance and great pay and benefits and health standards for its workers, and organic farming processes and recycling of water, and check all the boxes on the ESG scores, but nonetheless is still a tobacco company, I think we as asset managers need to do a better job in educating investors about what we're actually giving them. So if they say, I want an ESG fund, they know what they're getting. It's not necessarily the same as I want a fund that's helping invest in sustainable products that will transform the world economy.
Agree, Sandra. And I will say from a private equity point of view and from our point of view, this is why I believe, at least starting, I believe private equity has an important leadership role in this. And the reason I think it has an important leadership role is it ultimately comes down to these ecosystems. And I'll say in public forum, I think the future of private equity is a ecosystem-driven investment strategy. And the reason I think that's important is to be able to piece together how each component of the investment touches its stakeholders is where that transparency, that integrity has to begin. And it comes from a bottoms-up point of view. And so I know one of the things that the Economics and Mutuality Solutions Group is working on is the mutual value framework. Because if you can then begin to give operators, CEOs, visibility to how how that capital is deployed, how it impacts the various stakeholders, and then you can roll that up and you can communicate that to LPs, then beginning to benchmark market segments or industries will give asset managers a lot more fidelity, because it's not just one big blanket of ESG metrics. I think those metrics are going to have to be particularized in market segments or industry segments, because Sandra, to your point, there's this big, broad, massive, monolithic category of ESG, and that ambiguity doesn't really help investors understand the specificities of what's going on in a particular industry. So I believe going from the bottoms up is really critical. And my last statement on this is I love how this conference has even been architected from leadership to performance metrics to investment, because I think all three of those things are really critical. Because if you have, business leaders, investment leaders that are willing to employ those performance metrics, and then ultimately it's that we have the ability to aggregate, I think there's just a lot more transparency and a lot more actual insight to what these metrics are rendering with the investment activities.
I just want to react to what you said, Gavin. You mentioned the mutual value framework project that the Economics of Mutuality is actually working on. And I think it's interesting because Hiro mentioned the fact that to the question of calling what difference between purpose and ESG. And he said, look, the thing with purpose is we don't really know how to measure it. And if we actually come up with a set of metrics that are that make sense from a value creation point of view, both for society, planet, and organizations, at least at the industry level, I think that could definitely, I would say, enrich the ESG framework. Maybe I have so if we maybe set aside the role of the role we want investment to play in society, there is a question of there are a bit two scenarios, and I frame that as such, but I will let maybe Sarah react. There is one scenario of having investors as active investors, so encouraging companies to improve, to change their behaviors. And there is another one where we say, look, investors will be divesting or will be focusing on the most virtuous companies, knowing that those who will not actually, well, it may be acquired by other asset managers, or so. There's a question of what are your perspectives on the role investment should be playing, actually, divesting versus really, moving, changing basically behaviors of companies.
Yeah, so it's a critical question, and we actually just a couple weeks ago published an article in Forbes called "Investing Rather Than Divesting for a Greener Future." So anyone who's interested can look in more detail. But we think that while divestment seems appealing, it has a number of limitations. The first is you can miss assets and miss companies that are really transitioning. So you just from an investment point of view, you can miss out on real change. And what we see is real value is usually created when people are really changing and innovating and doing something different. So that's the first thing. The second is we have to remember, you used the phrase of putting the garbage in the neighbor's yard. That's a good one. But sometimes it makes your portfolio look better. But it is really just giving it to somebody else. And we need to remember that one person's divestment is somebody else's investment. And so it might make us feel better not to have it in our portfolio. But if it's still in the world, we really haven't done anything. And the third thing is that it leaves you with no seat at the table, as you mentioned. So what we're trying to advocate, and you talked about it a little bit, but is thinking about different portions of a portfolio that may fall in different categories, and not being right or wrong, but being very honest about what you're doing. So the first is being silent on climate. There may be big parts of the portfolio where you are silent. You don't have a view. And I'm going to give you an example, which is U.S. Treasuries. I would argue if you own U.S. Treasuries in your portfolio, you're not making a climate statement. They just are what they are. They're just there. So not good or bad, just what they are. So silent. Second would be really what we think of as analytically incorporating expectations about the future into investing. And I think of this as really just good fundamental investing. So for example, how do you price in the possibility of a carbon tax? That's not judgmental, but it certainly could happen. And how do you invest in climate solutions companies with a venture mindset? So as we know, plant-based meat or whatever comes from venture companies. So there are a lot of venture companies that you could invest in purely from a financial point of view because markets reward companies that solve problems. So we think of that as being very analytical. The third, which is particularly important for big investors, is being catalytic, throwing your weight around a little bit. If you are a big investor, whether you're an asset manager or an asset owner, you can scale solutions. You can scale green infrastructure, for example, or really just drive engagement because you do have those votes or you do have that amount of money really engaged. And so those are sorts of the examples we think of that. And then the last is what we think of as principal investing, which is to say, you mentioned tobacco earlier. I don't want that in my portfolio. I don't want to be associated with that. And it's a principle, and I don't care if it makes a lot of money. It doesn't matter to me. I just don't want to be associated with that. And I think that there is absolutely, or a concessionary return. I'm going to invest in something that's between a real investment and philanthropy. But I think what's really important is to understand that that principled approach may be extremely important for your brand or for constituents or for other people in some way, even if it doesn't really affect the society or planet. But the most important thing is to be honest about why you're doing it and take that top-down strategy and say, we're going to invest this way because we believe we're going to make money doing it. We believe we have a role to play. We're going to follow our principles and be very clear about that. I see much too much of the sort of mushing it all together or saying, well, I can have my cake and eat it too. We think that sort of strategic mindset is critical.
Thank you, Sarah. I don't know if Sandra, Gavin, you want to share also your perspectives on that question of investing versus divesting.
Sandra and Sarah both know Nadia as you do that. Part of my history is I was a failed seminarian before I turned into an investment professional 20 years ago. And the reason I say that is I believe in redemption. And so that, in other words, I believe that things can be transformed. And I actually think that's critical to this overarching strategy. And so to Sarah's point, the premise of just divesting, being done with it so that one can have their own sense of fund integrity or investment is not solving the problem. So a transformative approach, I think, is really critical. But that gets back into this whole idea of, I would say this, we have to stop presupposing that implementing these approaches toward managing human capital, social capital, and natural capital is a trade-off for financial returns. We have to stop presupposing that. And I think this is where the operational side and the leadership side of this conference is so important. And the performance metrics is we have to fundamentally believe that measuring human capital, social capital, and natural capital provide us visibility into leading indicators to how the asset and how the company, how the sector is performing. And I say it this way: as an investor, what are you looking for? You're looking for differentiation, you're looking for growth, but you're also looking for risk mitigation and predictability. And so what I love to say is this approach is actually simultaneously able to drive alpha, but also reduce beta. And I think we have to believe that these approaches actually do that, as opposed to predicating that, we're just doing good and there's a trade-off. This is, as far as I'm concerned, this is not a trade-off. We're building better, more resilient, more valuable businesses by incorporating these operational approaches.
Well, and for my part, I sit in an institution where the majority of our assets are invested in index funds, which does not give us the option to divest anything out of those portfolios. So I'm going to say, not surprisingly, that I don't think divestment is the answer to every question. It may be for some clients in particular. For us, there's also a question of operating in the world that we live in. And if you think about it in climate terms particularly, there is a need for fossil fuels over the next several decades. Renewables, despite all the money that has been and should be put into them, just can't scale up quickly enough. And so the fossil fuel companies are not going away, and our feeling on them and also on all sorts of other companies is engaging is really the way to drive change. Right? We have a big voice. We vote on behalf of a lot of shareholders, and that gets us a meeting, a seat at the table, the opportunity to say, we think your on the right track or you're not. And we at BlackRock put a lot of time, effort, and money into that stewardship because we think we're doing it on behalf of our clients. We know that the ones in index products don't have the chance to divest, and we want to get the best long-term outcome. And we think that that is best done with the seat at the table.
And can I ask you, Sandra, because I think everyone knows that everyone knows Larry Fink, that the chairman and CEO of BlackRock, who has been very vocal on the topic of purpose and sustainable value for all stakeholders. And BlackRock, if I understand right, has asked all companies to actually publicly report in line with the TCFD and SASB, and they are both actually in a single materiality logic. So the impact that people, planet can have on the company's performance. So my question is, why have you made these choices, and to what extent you believe that it will actually drive changes within the corporate world?
We think the reporting is incredibly important because investors need to be able to understand what they're getting. And so much of the conversation about ESG and stakeholder capitalism is sort of ethereal, not data-based. It's very normative. And so we think to make good investment decisions, you need data, you need transparency, and you also need standardization, because when you're looking at global portfolios, you simply have to have something that's comparable. We think TCFD is a great framework for climate reporting. I think on SASB, we are looking for SASB or something comparable, understanding that not everybody uses SASB standards. But again, we want this comparability, this standardization, this just ability to make better decisions based on the information that you can get.
So if there is at some point a framework of double materiality that also shows the impact that companies are having on people and society, that's something that you would be interested in, I guess, if there is something that you find robust enough to compare companies against one another and just assess also their footprint on planet and people.
Yeah, well, we're cognizant of the burden of reporting on companies, and we don't want to make that just intolerable. But we do think the more sustainable, the more materially relevant the data is, just the better the investment decisions can be made. So yes, we're interested in all sorts of efforts to come up with better data.
And Nadia, this is where I'd like to put on both my CEO hat and my technologist hat. Because as a CEO, I want that data to be able to reflect the activities of the business. So it's not just a compliance function, but it's actually an operational empowerment. And so if then again that can be rolled up in sectors and we can benchmark against that, then now we're starting to talk about massive amounts of data. And I think really I'm thrilled that day one had someone like Mark Benioff in this conference, because technology investors, I think technology has a critical part to play in ESG reporting and making this, Sandra, to your point, not necessarily just an onerous compliance function, but something that's actually providing visibility and operational viability to decisions that can be made. So I think for that transparency, like we have to remember that technology and data calls, and therefore, to Sandra's points, that means standards and those sectors have to be clearly known. We have to know what we're reporting to. But I think the technology piece is a critical element of the next evolution of this way of investing.
Yeah, I agree. So I think there's probably also the design of the right metrics that we think are actually drivers of outcomes and societal environmental impact. And as you said, also the way to report on them in a simple and in a simple way, and that CFOs don't end up with I don't know how many metrics to report on, depending on all the different frameworks. Maybe, Gavin, I want to ask you, because you've started touching upon the question of, an ecosystem-based approach in the PE space, and the idea that non-financial forms of capital are also driving financial performance. So I'd love to hear your thoughts on how you're thinking of building an approach to PE that puts purpose front and center, and that including obviously an ecosystem-driven approach from the beginning, meaning from the moment you actually deploy capital?
I'd like to give Nadia, if I could, like 2 examples, one within our existing portfolio, and number 2 is how we're thinking about the future of private equity investing based on an ecosystem approach. With our existing portfolio, we're literally trying to align our ecosystem. We're working on an initiative where our biggest customer and one of our biggest partners, we say, is trying to solve one of our biggest challenges for the biggest impact. And as a technology investor, and we're investing in developing talent in this world that is driven by digital transformation right now, there's such a shortage of talent. And what we're actually doing within our ecosystem is trying to identify overlooked and under-resourced people and actually put them in opportunity creation, opportunities to learn a technology development skill set. And so we're really committed to wherever we do business, there is a local ecosystem. So if we're doing business in that place, that means we are hoping to make the place where we're operating and working better. So that's one area, and we went through an ecosystem approach. But to me, the more innovative and the more important is beginning with an ecosystem approach. And so we're actually working on an initiative. We're partnering with the EOM Solutions folks of actually defining a problem set within the food supply chain. It's a massive area. It's a big problem over the next decade as global population increases and the food supply chain is limited, and there's massive amounts of waste and inefficiencies there. We're trying to begin with purpose, define the ecosystem, basically architect an investment thesis, and begin our approach toward deploying capital by prioritizing assets and companies that we believe that can contribute to that overall purpose. And therefore, by the way, that shapes the way we talk to our LPs, interestingly enough, because we're actually talking about purpose from the outset. So, do we have a financial model that we're putting in front of our LPs that's based upon, generating, solid returns? Of course we do. But even in the process, we're talking about the purpose in the sector. And when we look at an asset, we're actually diligencing it with the idea of how impactful and how purposeful we think we can be deploying capital, the transformative effects that we can have by making an operational change or a transformative change within that asset. I think that's really quite cool, because back to this whole private equity ecosystem approach, we're actually saying to our LPs, not only are we doing some good things, we've got an approach that we believe we're creating value by employing this methodology. And I think that's a new narrative to be able to go to institutional investors and family offices alike, which I'll go back to one of my previous comments. So if then we can have longer term investors who are willing to go on a ride with us for 5, 6, 7 years and still be focused on MOIC, maybe a little less focused on IRR, a little more focused on return on invested capital, but the whole investment premise is predicated upon a transformative approach to the assets. That really makes, at least for me, a really interesting approach toward both LPs and toward the companies that we're acquiring.
Thank you, Gavin. And it may sound like the next frontier, the future of private equity. Sarah, can I ask you, so we've discussed private equity, but if we take investment more broadly, what do you think will be a driver of systems change? And what are the levers that will be critical? We've heard a bit earlier, Hiro talk about, having a bit of a stakeholder alignment, better integration across different players. We've heard about the measurement piece, not just doing less harm, but also measuring value creation and to what extent actually what companies are doing also improves outcomes for planet and society. We know that regulations are coming in some jurisdictions. So what do you think will actually fundamentally move the industry?
Yeah. So we've done a lot of thinking about what really does create value over the long term. I think Gavin referred to being long term. Obviously, Sandra knows that index funds tend to be very long term investors because they can't sell it. So the first thing is really having that long-term mindset. And there's a difference between being a trader and being an owner, and acting like an owner is very different. So let's just put that all in that context. But then as we have done research over a number of years, what we see is there are really 5 things that drive value, creating long-term value for all your stakeholders. The first is governance. And so it's essentially impossible to have a long-term sustainable organization if you have short-term governance. That just doesn't work. So that's critical. Governance is the first thing. And we think that's very important for companies and investors. The second is the alignment of incentives. As much as we may or may not like it, people do incentives, right? People do what they are given, either compensation or other sorts of kudos to do. So the alignment of incentives is critical. And if we provide an incentive to do a short-term behavior, for example, and expect them to do a long-term behavior, that's nonsensical. So the alignment of incentives is critical. The third is, and we've talked about this some today, engagement between companies and their investors. So Sandra was talking about this before. Having that real engagement, we think, is a very, very important part of this mix, rather than just sort of having the investor buy or sell a security without having any conversation. The fourth, we've also talked about reporting and metrics. Full disclosure, I'm on the board of the Value Reporting Foundation, which is a merger of SASB and IRC. So I'm a big believer in the SASB and IRC mindset, which is really to focus on providing, under the new ISSB structure, materially relevant information for investors so they can make good decisions, and getting, importantly for investors, getting that information sort of integrated with everything else on the desktop, if you will. So it's not, I'm going to make an investment decision and I'm going to make a sustainability decision. So it's all one thing. That's what we've got to get to. And then the last of the 5 levers is policy and regulation. And as this conversation has already mentioned, that is stronger or more advanced in some countries than others, and really is the place where those political decisions have to be made about who should, what should the principles be. That those are political decisions much more than ones that can be made by any investor. But the one thing that I would add to this conversation is that most of the time in these conversations, we hear about how investors can do good things through the companies that they're investing in. But really importantly, I think investors can look themselves in the mirror as well and ask, what can they do themselves, not just through the companies they're investing in. So many asset managers have been seeing sustainability as a way to gather assets. We've talked about how ESG, or whatever they're called, funds have grown dramatically. And so for many, this has been a way that they've actually created wealth, is by gathering these additional assets. So we're also recognizing that the most forward-thinking are thinking not just about what they can do through the companies, but themselves. So I'll give you a couple of quick examples. One is being sure that their actions have a real impact on planet or society, not just on their fund profile. So that's a fundamentally different way of thinking. The second is being very clear, and Sandra mentioned this, about how they do or don't incorporate responsibility into their investment process. There is a lot of fuzziness these days. And the third is how they can contribute with their own firms and their own funds. So for example, hiring diverse service providers rather than the usual suspects, buying offsets out of their own pocketbooks to offset portfolios that they have invested in. It's very hard to do that with the client's money. It's not hard to do that with their own money. Or, for example, providing real training and development. And Gavin, you mentioned this in the tech space, but in the investment space, so that over time, investors would become less overwhelmingly white men who've attended elite schools, and that is an opportunity that's open much more broadly. So I guess I'd like to just point out that investors do control a great deal of wealth and make important decisions about themselves as well as about the companies that they invest in.
Thank you. I don't know, Sandra, is there anything that you want to react on based on what Sarah shared? in terms of these 5 levers?
Yeah, I would just echo the point about regulation and the political decisions that need to be made. There is some criticism of large index managers that they're anti-democratic because they're trying to set standards around things that government should really be setting standards about. I find that really interesting, but that's not what we are trying to do. We are not trying to advance an agenda. We are not trying to set standards. We are responding to our clients who are saying very clearly, we care about these things and we want to put our money, channel our own money towards investments that improve the planet in different ways. And we give them a lot of options of ways that they can do that. But we are really trying to funnel their views and fulfill our fiduciary obligation to do that. We're not trying to usurp governments. We don't want to be the ones setting the policy. We would like more guidance, but also really more political agreement on what's appropriate and where countries want to go. But in the meantime, we have to do what our clients are asking of us.
And hopefully there will be some sort of political alignment. We won't end up with too many different regulations across the world. I would like to pick some questions from the audience. So there is a question from Dan that may be more for Gavin, but obviously, please feel free to step in. A question is around how are M&As being restructured to move away from short-term incentives? Doesn't have to be you, but I know you know that space very well, Gavin.
Well, I can't comment to the number, although I will say the trend in private equity, I'd say over the last 5 years at least, is we're seeing, I'll call it more longer term minded investment mindsets. There's some groups out of New York that have aggregated some ultra high net worth family offices that are in for 7 to 10 years. They're very reputable, candidly ex-Wall Street kind of M&A types that have made a major shift in the way they aggregate capital and who they're aggregating capital and pulling capital with, and the terms. So I would say, personally, seeing in the marketplace, there is an increase. Still, a lot of funds are, this is one of the comments that Hiro made in the previous session, which a lot of the funds are inhibited by their charters. So I think you're starting to see some more creative fund structures, more creative funds that maybe transcend kind of the typical funds structure. We're even seeing, we function often as an independent sponsor. Independent sponsors can aggregate meaningful amounts of capital without being beholden to those very specific charters. So I would say the answer to that question is it's an increasing trend, but still the minority. It's still the exception and not the rule.
Nadia, can I add one thing to that? I'm not sure exactly what Dan was asking, if he was talking about just in the private equity space. But if you think about M&A deals more broadly, one of the things that I find very interesting these days is that, of course, many of the large investors will have to vote on multiple sides of these. So, there's this sort of naive view in the world that, somebody owns a stock and they care a lot about that company, and that's the only company they care about. But that's not the way it works. So typically big investors might own the acquirer and the acquiree. They might own the acquirer and perhaps another bidder for the same target. So you could have 2 or 3 or 4 companies involved in a merger deal. And then the investors really have to think about which combination, which are they going to vote for, because they may be asked to vote on several sides of these things or to sell their shares, depending on how they react. And so I do think that one of the things that has changed over the last number of years is that the people who are managing those sorts of deals understand that somebody is not acting just as a shareholder of one company, and they have to make the long-term case for many of the people who are involved in that deal. And I think that is the one thing that is pushing against the short-term incentives. There are still many, many, many short-term incentives in the M&A market to get a deal done, and oftentimes for somebody to have a large payday on change of control. So there are many, many short-term incentives in the M&A market.
There is, thanks, Sarah. There is also a question from Rick. Who is asking, with all the money available for big corporations to transition into sustainable business models, how can we fill the gap with SMEs that make up more than 90% of most economies? So, well, again, I know PE is actually mostly an SME space, but I don't know whoever wants to answer or bring some elements of response to that question.
Well, I'm happy to add one thing, and I'll see if Gavin wants to add others. But I do think that I think the premise of the question is that big corporations have a lot of money to transition, and I think that is true. There's no question about that. But I think we also need to remember that most innovations in our economy have not come from those big companies. They've actually come from the SMEs or from, some kid in their dorm room or whatever. So I think that what really is important is that we have capital that can fund the full range. So somebody who's got the crazy idea about a new sort of energy. You saw there was a big energy deal that was done yesterday about fusion. Okay, that was funded mostly in an academic setting. So I think that what's really interesting about funding the SMEs is they do make up huge percentage of economies, and they make up huge percentage of innovation. So as we think about climate solutions in particular, having funding for the person with the crazy idea about, algae that's going to eat plastic out of the ocean or whatever that might actually work is critical. And I think that's something that investors can do well, which is just place some bets on some of those, crazy kids in their dorm room, because they might come up with the right answer. And that would really be beneficial for all of us.
Firstly, I think I'm just going to be quiet and let Sarah answer all my questions because what you just laid out, Sarah, is so compelling. It's honestly why I'm a middle market private equity investor. Is I believe, to Rick's question, there's so much innovation to create. There's so much opportunity. And I'll say this, as a financial investor, that is of the private equity sort, I do have a lot more tools at my disposal, and I can be agile and I can affect a lot more change. And one of the things that we're doing is, we're acquiring good-sized companies, but then we're tucking in some of the innovative technologies because we're able to actually get those technologies out to market faster. So I don't mind having a venture mindset and also having kind of a traditional leverage buyout private equity mindset, because I think if I'm driven by purpose and I'm trying to affect some kind of desired outcome for that particular sector, it gives me almost a little bit of an asset agnostic approach, because ultimately what I'm trying to do is I'm trying to get a purpose accomplished within in that given area. So I would say, the more that financial capital is driving that innovation at the middle market, lower middle market basis. A great example of that is, Climate Corp did extraordinarily well and got to, I think, over $1 billion in enterprise value, and Bayer bought it and acquired it, and that is a transformational asset for a very large multinational corporation, using innovation that took place that got some scale, and it was a crazy idea. And those crazy ideas have matured into a real market.
Sandra, thank you, Gavin. Sandra, can I let you conclude? It doesn't have to be related to the question.
Well, in that case, I will say thank you all. This has been such an interesting discussion from my standpoint. And I think that there's much more to do. And hopefully in 5 years, the conversation will have moved on significantly. But it's very important, I think, for our industry, particularly, to really be clear about what we're doing and who we're doing it on behalf of and why. And it's important for investors to really understand what they are investing and putting their money in, and understand the motivations for doing that.
Thank you so much to you, Sandra, Sarah, Gavin. It was an exciting discussion and a lot of food for thought. So I hope, everyone enjoyed. And thanks again.
Thank you, Nadia.
Thank you.
Indeed. Thank you, everyone. Lots of great food for thought. And I will say there are plenty of college students and MBA students listening to this conference. So maybe some of them have those ideas that we are looking for. Thank you again to our panelists. Next up, I would like to let you know that there is an exciting opportunity to learn about a brand new tool that was developed by Economics of Mutuality. Please stand by.
From confusion to purpose. From empty talk to bold action. From proving you're good corporate citizens to improving your performance and impact. Measure and mobilize your purpose with the Economics of Mutuality Purpose Scanner.
Good morning, good afternoon, good evening. Welcome to all. And I hope you've enjoyed the short video on the Purpose Scanner and it has made you want to know more about it. And that's what I will be talking about. My call to action today is about purpose, as you can imagine. I just want to quote an Oxford professor, Clive Staple-Lewis, who said, "Purpose is like a light. You don't turn a light on in a dark room to stare at the light." So what does that mean? Organizations should use purpose as the light to give purpose to their employees and to illuminate the problems of their stakeholder. So why does purpose matter? You know that it does matter at the level of the organization. And if you were not convinced, I hope that the last 2 days I've managed to convince you. It matters for people, it matters for society, it matters for organizations' performance and resilience in the long term. But individual purpose also matters. Individual purpose is your calling, your vocation, what gives you energy, what makes you feel alive, what brings you a sense of fulfillment. And I want to share a few facts on why it matters so much. So the CEOs, if you look at CEOs first, 60% of CEOs actually want to become purpose-driven. Of course, because purpose has become the #1 factor in driving innovation and business growth, but also for personal reasons. And you've heard the top three CEOs talking about their own journeys a couple of days ago, sharing their personal experiences, their personal excitements. So it also matters for personal reasons. Surprisingly enough, at least to me, 70% of people said they would define their purpose through work. But only less than 20% of people are actively engaged in Western Europe and actually throughout the world. It is true for all regions of the world. But purpose is fundamental, and the individual purpose is fundamental. Employees who say they live their purpose at work are 6 times more likely to want to start a company, 6 times more likely to report higher resilience, and 4 times more likely to report better health. So it seems, I hope you understood, individual purpose is also key as organizational purpose. So now how do we connect the two? What can we do? Hubert Joly, whom you may know, is a former CEO and chairman at Best Buy, the US-based consumer electronics company, and is now a professor at HBS. He said, without linking it to individual drive, a company purpose has no soul and no legs. Clearly articulating and feeding the connection between personal and company purpose is therefore one of the most crucial roles of any leader. It is the role of organizations to understand what drives people, to help people identify and articulate their purpose in relation with the organization's purpose. And that is why we, the Economics of Mutuality, have actually teamed up with thought leading academics to measure both individual and organizational purpose and help organizations mobilize them. That has enabled us to basically complete and enrich our existing well-being at work survey that we also had developed with academics and that we had tested also in different organizational settings. Now, what is the purpose? And that gave birth to the purpose scanner. So what is the purpose scanner actually exactly measuring? It measures your purpose and the purpose of the organization. So by your purpose, there are 4 dimensions that we look at. Me in my life. So basically that relates to the objectives and aspirations in your life. Me and my job, that relates to the extent to which your job brings meaning to you. Me in my organization, the extent you feel you belong to an organization driven by purpose and values consistent with yours. And my organization in the world, the extent to which your organization acts consistently on its purpose and makes a positive impact in the world. Based on that purpose scanner, we wanted to actually run a global survey across 18 countries and 15,000 employees, and we've started with 7 English-speaking countries and 5,000 employees. The 7 countries are the US, the UK, Sweden, Singapore, South Africa, Nigeria, Australia. And what were we looking after doing this survey? There were a few questions that we were wondering about. One is the extent to which the SDGs are actually consistent across very different countries. And the surprising fact is that the top desired SDGs are actually very consistent across the 7 surveyed countries. And as you see, the number 1 is good health and well-being. Number 2, decent work and economic growth. Number 3, quality education. Number 4, gender equality. It doesn't mean there are no differences, but the picture of the top SDGs looks very much the same. On the contrary, if you take climate action as an example, you see that it ranks very differently across countries. So very second actually in the UK, but much further, for example, in Nigeria or Singapore. The second question that we were looking at is to be able to understand precisely the contribution of purpose as in people satisfaction at work. And interestingly, what we came up with is that purpose is actually the missing link to understand what drives employee satisfaction. If you take, for example, I would recommend my organization as a place to work and understand the different blocks that explains the differences in satisfaction. You see that the traditional drivers of satisfaction, e.g., age, gender, role in tenure, role in organization sector, but also income satisfaction and working conditions like workload, hours, equipment, explain about 25%. The second block is less traditional ones that you find less typically in surveys, is around the trust at work. Meaning trust with your colleagues, trust with your managers, trust with leaders. And the last block is actually around purpose and common values that explain about 20% of differences in employee satisfaction. And by purpose and common values, you can think of a meaningful job, alignment with the organization's purpose and values. And that is true not just for measuring. I would recommend my organization as a place to work. The role of purpose is actually true in all the outcomes that are related to satisfaction. So it is true, for example, in terms of job satisfaction, which you see at the bottom. It is also true for I am proud to talk about my organization, which you see at the top of the page. So even if the numbers are slightly different, the patterns remains the same. The third question which we had was around understanding if there were major differences across people within organizations in terms of how they're living their purpose. And I have to say that we were quite surprised to see that in the US, managers and executives are actually much less satisfied than employees, respectively 40% and 50% less likely to like their job than employees. So why is that? Well, it seems that there is a conflict between their purpose and personal values on one hand, e.g. Doing right for the external stakeholders and delivering business results on another hand. They are more likely to say that their organizations are actually profiting from creating problems to society, to people and planet than employees. So we do believe it is high time for organizations to be truly purpose-driven, to align purpose at all levels within the organization in a credible and consistent way, and basically to help us live our purpose. So if you want to know more about the Purpose Scanner, please do reach out to the Economics of Mutuality team. We do believe that the Purpose Scanner can really help your organization ensure purpose is well understood, is shared, is embedded in the organization, drives strategic actions toward people and planet, and ultimately is useful to the world. And I would like to thank you, and I also would like to say that, well, I do hope the next decade will be a decisive decade for purpose and prosperity for the world. Thank you.
Thank you so much, Nadia. And I am pleased to announce that the next session of our forum is one of the most exciting parts that past participants have enjoyed. We are going to have a chance to observe the Oxford Union debate style with a number of our MBA candidates. So I would like to welcome to the stage the president of the Oxford Union. And as you can see, we virtually moved over to the hall there, Chengai Shi, and invite you to open the debate, and we'll bring our fantastic MBA candidates on to join you.
Thank you, Amanda, and all the organizers and the participants for the Economic Mutuality Forum. It is my great pleasure to welcome you all virtually to the debating hall of the Oxford Union. And it is my pleasure to chair my penultimate debate before our final end-of-term debate happening in the debating chamber at 8:30 tonight. I hope some of you are able to join us one day in person in the debating chamber to have the Oxford Union debating experience. But I'm honored to preside over a rather exciting debate tonight. The rule of British parliamentary debating is we will be alternating between the proposition speakers and the opposition speakers. Normally, you'd be able to raise point information, but for this specific format, there will be a section between the second pair of speaker and the last pair of speaker for audience to ask questions, to give comments, and hopefully the last pair of speaker would be able to jump in and summarize the debate. Now, without further ado, I would love to kick off the debate tonight. The motion before the House is this House believes that impact investment reinforces unjust system. And to open the case and to start the whole debate, I call upon Shenji Shi to propose the motion.
Well, thank you very much, Mr. President. Good morning, good afternoon, and evening to all the current and future responsible business leaders. Well, as the proposition team, we've recognized that impact investing is becoming a sexy topic now. An old practice, but new science. It has been seen as a magical force that can tackle societal problems without sacrificing performance for the investors. A very beautiful win-win story. Some may even argue that impact investing can resolve our unjust systems by providing easier access to capital for the ones who are in need and by finding a solution that addresses social problems. However, let's take a moment. Is it really true? Can impact investing really save our unjust systems? As the proposition team, today we will show you layer by layer why impact investing is not the magical force that you think it is. To begin with, our first argument is that impact investing does not address the full complexity of the unjust systems and does not drive the real transformation that we truly need. There are profound limits to what business can do profitably. And to address the system problems, it requires system solutions. Business alone cannot do much. For instance, let's take a look at investment in climate change. A recent report by the Energy Research Center of the Netherlands has estimated different investment costs of reducing greenhouse gas emissions. Based on the report, there are only a few investments that are profitable, such as household energy efficiency projects like solar panels or the best sites for wind power. However, to limit global warming to 1.5 degrees, those activities are not enough. We also need to find unprofitable solutions. For example, expanding wind energy to the unprofitable areas or investing in carbon capture and storage. And those unprofitable investment choices actually contribute the most in terms of tackling climate change. And the most important thing is, the rich country may be able to afford the unprofitable technology, but the poor countries may not be able to. Without system-level changes, such as providing subsidies on the international level, most of the crucial technology to address climate change will remain unprofitable for private investors, and they will have very little incentives to fund those solutions. And the low-income countries will be even excluded from accessing such technologies. The real transformation requires change the rules of the game. In the case of climate change, the current rules of the games do not reward carbon mitigation nor incentivize different nations to fight climate change altogether. The same truth also applies to many other social and environmental problems under the unjust systems, from pollution to poverty to poor public health. Not only impact investing does not address the system level of problem, moving to our second point, we would also argue that impact investing, by still anchoring to market returns, actually would slow down the process of real transformation and may even cause harm in some cases. For example, let's examine the case of microfinancing and poverty alleviation. The idea of microfinancing is simple. By giving a small loan to someone living in a poor country, you would help them expand a small business, which would lift their family out of poverty. When they pay back the loan, the money can be cycled more to the other borrowers, getting more family out of poverty. It sounds like an elegant win-win solution to the problem of poverty. It sounds like a beautiful picture that the rich world can eradicate poverty without any cost and without any threats to existing arrangement of political and economic power. And what is more tempting is that promise that we can help save the poor while still making money. Well, it's better than any of the Disney stories that I ever watched, to be honest. However, in reality, there are a lot of failed microfinancing cases and even exploitative microfinancing institutions because the nature of impact investing is still looking for satisfying financial returns. Well, you may argue back saying you have heard some cute anecdotes about how microloans made some rural woman's business thrive in, let's say, South Africa. Well, based on your survival bias. But in reality, actually, many low-income borrowers not only need to pay back the loans with interest rate, but actually they also face problems of setting up successful business due to low local demand. Think about this. After all, their potential customers are also poor, hence low consumer consumption demand. In quite some cases, maybe the new business will even fail, which leads to a vicious circle of wrapping themselves in layers of debt and drives borrowers even further into poverty. Some microfinance institutions are even explorative, crowned with the moral halo but extracting wealth and resources from poor people. In the case of Banco Compartamos, who received a lot of money from impact investors and went for IPO. As a public company, they end up prioritizing their shareholders' value over low-income borrowers and charging sky-high interest rates to reach even to 200% annually. Compared to the microfinancing solutions, which is still looking for a financial return, in comparison, the alternative solution, just giving money to the poor for free, actually proves to be more effective. There's a growing body of evidence that suggests that direct cash transfer with no strings attached not only delivers success where microfinance fails, they appear to be the single most impactful anti-poverty intervention available. Experiments with basic income grants has been conducted in Mexico, South Africa, Indonesia, Egypt, and elsewhere, with all astonishing good results. They increase consumption demand, improve health indicators, and allow people to start small business that are successful because they can take advantage of the increased local demand. Well, in summary, I hope you agree with me now. Impact investing is not a magical fairy tale that just simply solves social problems while still making money. First, it does not address the complexity of the unjust systems. Second, due to the profit-seeking part of the impact investing, it may even become a blocker in our journey to change the world. If we continue just using impact investing to make ourselves, the rich world, to feel good about ourselves, we cannot move forward at all. As a proposition team, we urgently ask you to join us together, to look into the real root cause, the structural issues, to be truly empathetic and listen to the real problems in the communities and think more rigorously about what is the most effective way of doing good. Thank you very much.
Thank you, Shenju, for your elegant opening remark. Now I look to Emily Mello to open the case for opposition to speak against the motion.
Thank you. Thank you, Mr. President. Esteemed colleagues, thank you all for being here today to listen to us, to our debate. So we're here today to argue that impact investing doesn't reinforce unjust systems. And according to us as the opposition team, this debate is about two views. On the one side, the lens that impact investing is inherently making the world less fair and doesn't work properly, as outlined by my esteemed colleague from the proposition team. And the other lens, that impact investing is creating outcomes that improve these systems for everyone. Here on the opposition team, we believe in the latter. We put forward that impact investing allows systems to change and that more funding will make the world a better place. At the moment, to achieve the UN Sustainable Development Goals by 2030, we need an additional $2.6 trillion of annual impact investing. And this is funding that, if invested well, could improve the lives of more than 3 billion people who live on less than $2.50 a day, and slow down the catastrophic and irreversible consequences of climate change. We need impact investing to continue filling this gap and to create the impact that is quickly closing this gap. But before I like to get into my arguments and open the case, let me highlight a few points in response to the proposition. Firstly, this sense that impact investing is this idyllic solution that fixes everything for everyone. And that is not the case. Impact investing alone is not enough. We know it's not enough. There's published studies, particularly from the UNDP, saying that is not enough. Foundations, governments, and grants have a really important role to play in creating the opportunity to bridge this gap and to create the good that we need for everyone. And it's alone, it won't be enough, but it is a really important part in creating that overall solution. In addition to this, my esteemed colleague raised some very specific points about microfinancing and climate change. And impact investing isn't necessarily going to solve those things. And in addition, microfinancing isn't always commercial, and neither is climate financing, and both have a really important role to play. But what we're saying here is that in order to create the situation where these tools can be used most effectively, we need to use the system we can that creates this incremental change over time, which will in turn positively impact the entire system. Secondly, as the opposition team, we can see that we live in an unjust world, a world where things need changing, and this debate is how we make that change and how we take those steps towards getting us towards better. Thirdly, I'd also like to acknowledge that, based on the points made by the proposition team, that charity is a different debate, and charities do good things. But we think that this debate is about commercial investment and about how, as business people, we think about investing our money. Impact investment is not philanthropy, and it is very good, sustainable investing that we are talking about today. So let me make my case on behalf of the opposition team. So first, my first argument, I will talk you through how deploying impact investing through the current systems we have, we can make the world a fair and more just place. And secondly, impact investing makes sense and is creating the change that we're seeking to make. So firstly, impact investing creates outcomes to change systems. By putting money in investments doing social and environmental good now, we can fix and change these systems. And to be clear, this is not reinforcing the system as it is. It's using the current system to accumulate outcomes and change things over time. To create change, you need a lot of small ripples to form a wave and to shape the systems we work within for the better. For example, let's look at a startup creating this change. This startup is called Apolitical. Through providing training courses to public service employees, Apolitical are working to improve the skills and effectiveness of public services and government. Each public servant they train is one step closer to having a more effective and more efficient government system. Apolitical currently have over 100,000 users. They've taken on impact investment, and this is impact investing, creating change to government systems right now, which are organisations infamously hard to change and with change that is notoriously difficult to measure. Social impact investing in the UK has increased by almost eightfold over 9 years, from £833 million in 2011 to £6.4 billion in 2020, according to Big Society Capital's latest report. And globally, it now reaches an estimated $1.3 trillion of assets under management, according to the IFC. This means billions more investments in assets, companies, projects, and other classes that can drive the change that we seek. So our impact investing is already creating change. Which brings me to my second argument. Impact investing does not reinforce unjust systems because impact investment makes logical sense and delivers much needed funding to businesses doing good right now. Because who doesn't want to do good things? And who doesn't want their investment to make money and have a positive impact? You'd think it's a no-brainer. Here on the opposition, we're not necessarily advocating for a total portfolio of impact investment, but the recognition that many people can access impact investments to build into their investment portfolio. Right now, anyone trading on the London Stock Exchange can buy a sustainable ETF share for £6, which is 2 good cups of coffee, which can do good and create change over time. This creates an opportunity for new and current investors to move into sustainable investing, further democratizing the opportunity. When impact investing becomes part of everyone's portfolio, the combined outcomes build built up with numbers over time can have an even greater impact. These combined outcomes grow and shape the original systems, creating and changing them for the better. Money available here and now to work on these problems really matters. Here in the MBA, we've just finished accounting. Let me take you back into the classroom with Professor Richard Barker and his deep enthusiasm for accounting permeating through the warm classroom. Money available now is inherently more valuable than money available a year from now. This, esteemed colleagues, is called the time value of money. This means that the money that impact organizations can access now is deeply more valuable than this idealistic or problematic vision that the proposition is presenting. So to summarize, I've talked about how impact investing creates these great outcomes and how these outcomes change our systems to be more fair, more just, more inclusive. These changes are happening right now, and as money is pouring into the sector, we're enabling a greater number of people to ride the impact investing wave. This wave is shaping, shifting, and changing our systems for the better. As the opposition, we put to you today that impact investing creates positive change in our systems, is creating the change right now, and makes good business sense. We trust that you, as smart and sensible business people, will recognise this opportunity and surf this wave with us. Thank you.
I thank Emily for her opening remark. Just want to remind all the members of the audience, you can all participate in the debate by giving comments in the comments section. Now, I look to Morgan Muzzle to continue the case for the side proposition.
Thank you. I'm going to build on or take as a starting point, perhaps, the points of Emily talking about how the fact that high volume of impact investment and the fact that it's needed now and the fact that there are a few success stories means that it's necessarily a positive thing for society. Instead, I'm going to argue that impact investment is undemocratic, that it's misdirected, and that it's actually ineffectual in creating impact the way it's organized today. I'm going to do this through talking about where the capital is coming from, where the capital is going, and how it's structured to argue that impact investment, as it's manifesting today, is reinforcing unjust systems. So my first point is that impact investment is undemocratic. And what I mean by that is that those who have the power, and in particular the capital to engage in impact investing, are generally not those who will be impacted by the impact investments. And this is both true on the social and the environmental side. Socially, impact investments often work against inequality. Environmentally, they work on a global level, but we know that those less developed countries are often those that are most likely to be impacted by climate change. At the same time, we see that those who are intended beneficiaries of impact investing are not actually those doing the investing, and therefore they don't have a say in where that capital is actually going. So the fact that the majority of impact investors rarely have a personal stake in the problems they're attempting to solve can tempt them to chase easily quantifiable impact and surface level solutions that look good, but ultimately do little by way of systems change and even reinforce the system as it exists today. Some of the wickedest problems that we face today as society are not going to be solved by a simple formula of input and output, but we need people who really understand the complexity and are invested enough in the outcome of some of these wicked problems to invest to see through to real long-term change. If those who are already in power are continuing to create and shape the world to their liking, we often assume that making things market-based will improve people's access to free choice of goods and services. But in the case of impact investing, that doesn't actually shake out. For example, when it comes to impact investment decisions, are all dollars created equally, or does a dollar in sub-Saharan Africa go further than it does in the UK? Is quality of life more important or longevity of life more important? These are the types of decisions that people in power and people with the access to capital get to make moral decisions for all of society. What causes are important for the world and which solutions are appropriate, which is already how the world works today and then therefore is reinforcing unjust systems. Finally, we see that impact investment can be contrasted with alternative and more democratic approaches to societal change. For example, wealth redistribution or taxation and government programs. Now, as a business person, I recognize that these solutions are far from perfect, and particularly in countries where there's a high risk of corruption may not be the best solution. But I give this example to show an alternative world where beneficiaries of social investment have the agency and the choice to decide whether through increased personal resources or the right to vote, how they want to invest capital in terms of addressing problems that they're facing, which is really how a fair and efficient market should work. Instead, in impact investment, investors not only make these choices for them, but they also generate a further return on their investment rather than donating that money, and therefore sustain and reinforce their positions of wealth and power rather than improving systemic inequality. So my first point, impact investment is undemocratic. Second, impact investment is misdirected. And here I want to talk about where the capital is going. It's not going to only underrepresented markets and societal groups, but it's actually often going to salient groups with characteristics such as gender, race, and nationality similar to those who are doing the funding. We see that millions around the world are excluded from opportunity, trapped in missing and failing markets, and continue to be left behind. When funding is given to some of the most in-need causes, it's often not the type of unrestricted catalytical capital that's actually needed to build meaningful markets and shift systems over time. To give one example, in the United States over the past year, millions of dollars of pledges were given to Black-owned businesses and other Black community efforts in an attempt to solve problems of systematic inequality. However, research by Echoing Green showed that unrestricted funding for Black-owned organizations was still scarce and a tiny fraction compared to that of white-owned organizations, showing that even though Black Americans are accessing more funding, they are having less agency to build the systems in the way they want to see them because their funding is far more likely to be restricted rather than unrestricted as white-owned founders are getting. In my own work in emerging markets, I've become accustomed to foreign investors coming in and asking for highly specific investment candidates for $5 to $10 million US tickets, which businesses like this rarely, if ever, exist, but they could exist if they were given smaller investments and allowed to grow to that point. The pressure, though, to maximize profits and volumes in our traditional financial systems and transactions means that impact investments are not often enough going to low profitability or high-risk projects. In many cases, many causes first need some element of concessionary capital in order to become profitable, testing models that would otherwise be too risky for ordinary investors. I'd like to argue that if we're only investing in projects with the most competitive market returns as impact investors, why we actually need impact investment in the first place when traditional investors should be chasing these same investments as well. Impact investment can really only be helping society if it's investing in a less attractive investment that the market would otherwise not be investing in. Here I've talked about how impact investment is often misdirected, but I'd also finally like to close with my final point that impact investment is ineffectual in creating verifiable impact. The big promise of impact investing, which we all know and aspire to, is that profit and purpose can coexist. And I vehemently believe this is true. For the entire history of society, we've known that doing good is good business. Business has to sell a socially relevant product to stay in business. Businesses that engage with the community win customers. However, as much as profit and purpose can coexist, pushing for continually increased profits comes at the expense of impact and requires businesses to make social and environmental trade-offs, such as paying out frequent high dividends versus investing in long-term environmental technology. Super high returns rather tend to come from harmful investments because they're not sufficiently paying for the damage they're inflicting on society or the environment, whether through deforestation, underpaying their workers, etc. So until we create new standard tools and methods to internalize the externalities of how businesses operate today, our accounting will never fully capture the incremental societal value that's created by impact investment. And therefore, investors will not be sufficiently incentivized to truly put purpose on par with profit in a consistent way. My last point is that a lack of accountability on how and how much additional impact is being created is a problem here. We see ESG impacts in funds tend to be a bit more like bare minimum responsible business than anything really transformative or systems changing, but they give people the illusion of doing something good and that this is enough. Impact investments are also rarely held accountable for the results that they are turning, with the exception of a few new and up-and-coming instruments like SLLs and results-based finance, and they're very infrequently subjected to independent evaluation and verification of their impact results. Finally, and this could be an entirely separate debate in and of itself, there's too many competing definitions of key impact metrics. What good looks like remains largely qualitative, subjective, and unable to be compared. And we know that when there's not a fair process in place that everybody understands, the existing system and those who are currently in power will prevail. So I've tried to argue here that impact investment as it stands today is being practiced in a way that's undemocratic, is misdirecting capital, and is ineffectual in actually creating meaningful impact, and therefore is reinforcing the unjust systems of today. Without changing the underlying tools and ways of working of our financial and other economic and social systems, I believe we'll keep generating the same results and sustain the status quo. For impact investment to be successful in changing unjust systems, I believe three things need to happen. One, capital allocation decisions need to fully and wholly include those that they intend to serve and benefit. Second, capital needs to be directed to where the biggest needs are, even if those are not the most profitable. And third, capital structures need to be designed for catalytic impact and understanding where the tension will exist between profit and purpose. This is not what's happening in impact investment markets today. And that's why I'm here arguing that impact investment as it currently stands is reinforcing the unjust systems. Thank you.
Thank you, Megan, for your excellent contribution to the debate. Before we move on to the next speaker, I just want to say there are many comments rolling in the comment section. Everyone are welcome and encouraged to actually address any questions, any comments in the comment section. And in the next round, I'll be able to read out some of the comments to our debaters tonight. Now, to continue the debate for the proposition, I look to R.A. Billy to speak.
Hello, everyone. Thank you for joining this on a Thursday evening. I'd like to thank the proposition for bringing up these points, but I'd like to return to discussing the benefits of impact investing. I also recognize that in a debate setting, you probably want me to disagree with you, but I actually agree with a lot of the points that were being made, but only if they're about changing the entire system. Now, I know that in 2021, we all crave the revolution, but the time frame for that might be a little bit too long term. And I think in the meantime, the systems that we're suggesting have the capacity to provide power to those who lack it. And I think that those systems are to be relied upon, at least in the short run. Now, as we've been learning in our analytics class, all the models have some degree of error, but I think that we should look at the potential benefits. So speaking of some recent potential benefits from investments, BlackRock is a massive investment corporation that I'm sure we've all heard about. And through their impact investing, they've been able to achieve the following: 102,000 gigawatts per hour of renewable energy generated, 11 million metric tons of food waste mitigated, 114 million individuals empowered with access to financial services, 99 million people given access to clean drinking water, 60,000 families given access to affordable housing, and 1.8 billion patients given access to affordable healthcare. Now, while some of these metrics may be not necessarily done through pure altruism, while some of them may be, I don't know, not completely perfect, that being said, that's still a massive impact. That's still a lot of people that were helped, and we can't argue that it wasn't helpful. These changes were not done in a vacuum, and those who benefited from them did benefit. Those are still outcomes that were created. So I believe that if impact investing is done right, I will agree that there are cases when it's done wrong, but when it is done correctly, I believe that it allows for more sustainable support to pursue important social causes. In Judaism, we have a concept called tzedakah, which is a different way of viewing charity than I think often is used. So in tzedakah, in the Torah, we have this thing where essentially when you have a field, you're not supposed to gather all of the food from that field. You're supposed to leave about 10% of it ungathered so that the poor can come and gather however much they want. And in the system, the poor are empowered to take what they specifically feel that they need. There's no benefactor standing over them saying, here's an apple, well, now you have to praise me. And Maimonides, one of our important writers, also writes that the eighth and highest degree of tzedakah is giving so that the recipient becomes self-sufficient and has no more need for tzedakah. So I believe that switching from the previously suggested sort of charity, nonprofit, single donations will allow the corporations who are getting that charity or getting that money to actually become more self-sufficient. And I believe that is done through the multiplier effect of added financial leverage. So let's say I am trying to donate money to someone and I have $50. If I'm just giving $50 to someone, I'm going to give it once because I only have $50 to spend at one time. However, if I know that I might be able to get some of that money back at some point, I'm probably going to give 100. And that means that that person's going to have access to a much larger capital than they previously would have been able to get. So impact investing allows investors to donate over and over again and allows them to donate a larger amounts up front, which would lead to larger capital being obtained by those people. So my biggest argument, or my first argument, I suppose, is that using the system creates opportunities for people that were previously stuck in an unjust system. During the pandemic, minority and women-owned minority and women-owned business enterprises bore the brunt of the system. Bore the brunt of the burden. And this was primarily due to pre-existing capital access challenges. That is the biggest issue that the businesses are facing. Now, the Paycheck Protection Program held out some hope, but it failed on many levels for the populations they represented. The other alternatives that existed during the pandemic were the first come, first served options, and it put a lot of those people at the back of the line. Only 12% of Black and Latinx small businesses actually received the full PPP requested amount versus 38% of all owners. And unlike banks, community development financial institutions don't actually have access to the liquidity facility at the same levels. So I think it's important because of that to embrace financial leverage and understanding that one grant dollar will only fill $1 of need, but leverage will create a multiplier effect. And nonprofits can use grants like down payments on a house and multiply those available dollars. For the point about impact investing coming primarily from communities with power and it not going to those who need it, I'd like to bring up an example that there are currently pension plans that exist that use impact investing to invest beneficiary money to the communities and the neighborhoods. So for example, a California teacher pension fund investing in affordable housing. My other point is that any investment doing good is still any good done is still good that is done. And while there may be concern about it coming from those with power, it's still bringing power to those who were lacking it previously. So as a summary, the benefit of impact investing is that it supports investors to keep investing, it brings increased amounts of capital to those who need it, and it provides support to those who then receive the capital to keep giving forward and investing in causes that they themselves care about. While it's true that those who have the power and capital are going to be the ones who are donating, I also think that it's the best solution to transfer that power to those who need it. There was another point that I'd like to address, that was that impact investing cannot include concessionary measures, but I'd like to point out that there are in fact models and clauses in a system that could allow concessionary measures. So again, overall, I agree that the system is unjust, but we support in creating better tools, and we don't believe in removing impact investing as a tool for us to use. Thank you for your time.
I thank Ari for your fine speech. Now we're moving on to the section where members can contribute in the comment section. I'm going to read out some of the comments, and for all the debaters who are on the call, if you want to respond to any of the comments, please feel free to put your hands up, and then I can call upon you to give some quick responses before we move on to our final pair of speakers. Yumna especially commended the speech where it said impact investing is using the current system to accumulate outcomes and change them for better over time. We've got comment from Anna saying systems are not unjust because of any external factor, like impact investment in this case, but by decisions of the units that create those systems after all. Yet any labeling needs a point of reference, which considered subjective is a never-ending debate. We've got Eve, who said, impact investing makes our system more just, more fair. We're changing our systems for the better. Comment from George, who said, robust ESG metrics and application, therefore, would play a key role in this. Jervis, who said, Morgan makes some good points. We want to be cautious that impact investing does not exacerbate the rich-poor gap. But she makes a false argument about voice. Many impact investing projects do give amplified voice to disadvantaged populations. Case studies have already proven that impact investing is actually helping underserved people achieve more progress. Morgan's doing a great job trying to make an impossible argument. Rob, who said this argument does make it feel that purpose and profit are somewhat zero-sum. Am I hearing that right? Andrea, who commented, impact investing needs to be defined properly and assessed with the right metrics. Then it is the way to go. Chris, who said, for all investments, impact or otherwise, it is important that regulators and consumers provide the right incentives for investment to lead to desired outcomes. Rob said, I like Ari's point, in the absence of a perfect system, we can get there in an approximate way while continuing to improve. Yumna said, Ari, I like the way you are weaving together business frameworks with societal philosophies, spiritualities to make your point. Weaving together business and our societal value is an important way to bring more people into this conversation. Jervis says, impact investing alone is not the panacea to the world's problems, but it can absolutely be, and already is, an accelerant for progress across SDGs, people, planet, and profit. Great discussion. Rob has a question addressed to Morgan specifically. The argument does make it feel that purpose and profit are somewhat zero-sum, repeated the same point previously. John asked the question, can impact investing attract a large amount of capital to a project? And he further added, in other words, is it better to empower SMEs or invest in larger companies which can possibly invest more money and create jobs and build infrastructures through tax revenue? If any of the debater wishes to respond, feel free to jump in. And I see Morgan has put her hand up. Morgan.
Yeah, I'll jump in just for the question that was directed specifically to me. Rob, it's a good point, and I guess it's a point that kind of has to come a little bit with the argument I'm trying to make, but I don't believe that profit and purpose are zero-sum for a couple reasons. One, I believe that business has to have a purpose in order to be profitable. It has to have some type of product or service that's offering to society that society wants in order for it to gain revenue and therefore have a profit. So in that sense, the arguments that profit and purpose are kind of constantly being traded off, I don't believe is necessarily true. They can, and in some ways they necessarily exist in good business. However, my point is that pushing for continually increased profits, as our financial system has done over the last several decades, squeezing more and more and more wealth out of companies in an extractive way that ends up taking money from, you know, the people who work there, for example, at the expense of shareholders. There are instances in which pushing profit to an extreme can hurt the purpose, or rather maybe better said, the social impact of that company and turn it negative in some ways. And I think one of the challenges with this, less so with income inequality, for example, between shareholders and employees, but if we take some of the less quantifiable things, for example, some of the, I guess a lot of environmental impact is quantifiable, but maybe some of the environmental stuff or some of the more social stuff that's less quantifiable, if we're not able to quantify or dollarize some of these social impacts, we will constantly struggle to make a good case for the types of mutual growth that we're trying to see. And so I think no, profit and purpose do not have to be zero-sum. They actually have to coexist, but when pushed to extremes, they can start to take away from one another, especially when some of the impact metrics are not able to be measured as easily as the profit metrics are. Thank you.
Thank Morgan for your response. Eve also commented on the same topic, who said, purpose will result in higher profit, so not zero-sum. We've got a further question and comment from Dan. I'm sure that impacting investment is positive, but a key point is that impact investment funds are not accountable for the non-financial performance. Measurement of success is often not defined. For example, a social impact fund aims to deliver 2% return whilst addressing homelessness. The purpose is clear, but the goal is not. Is it a 2% return and 100 people housed more or less successful than 1% and 200 people being housed? I would argue the latter, but with the investors or the managers. And Jervis actually followed up on this to say, great point, Dan. I wonder a 1% return would bring enough capital to house 200 people. Balancing the goals and the returns to find an optimal formula is what impact investing is all about. And now I yield the floor to Emily.
Yeah, so just in response to Dan's point around impact investing and those metrics, and I think that it's important to recognize that impact investing as a field, like a lot of fields, but globally is really still in development and is still improving. And one of those things I think that is really changing at a rapid rate is around impact measurement. And I think as the field continues to evolve, there'll be more and more opportunity for expectations for both investors and investees, as well as other stakeholders, to be clear around what the goals are for that impact, what impact it should be created, and exactly how that will be measured. And I think Dan, to your point, is really interesting because there's so many investment instruments at the moment that do define that impact very broadly. And I think one of the things that the leading organizations is doing at the moment is adopting things like the IMP, the IRIS Plus tools to really start to be more clear and specific around defining and measuring that type of impact as part of their investing instrument. And in order to measure that change, and I think that in terms of coming back to our debate topic, which is whether impact investing reinforces unjust systems or not, I think that some of the challenges, because systems change, systems is it can't measure, right? It's like such a big nebulous concept to try and nail down. But I think that the tools that exist in this space and are emerging in this space are providing really good frameworks to be able to start to quantify and really demonstrate how this current system is really furthering the opportunities and what exactly is happening with impact investing and the evolution in that space. So I think it's interesting. It depends on the financial instrument. It depends on the fund, that kind of thing as well. But it's definitely something that's growing and something that I've noticed over time.
Thank you, Emily, for your response. Now that I concluded our comment section, I want to move on to our final pair of speaker to continue the debate. To conclude for the side proposition, I look to Tanvi Ragaria.
Good evening, Mr. President and honored guests. Thank you everybody for being here. I want to start off by addressing Ari's point, very well made, about BlackRock's investments in the impact space. But also like to point out that BlackRock currently holds 6.7% stake in ExxonMobil, 6.9% in Chevron, and 6% in Glencore. They've also been accused of constant escalation of housing costs for their tenants by hiking rents, in some cases 30 to 50%, and ruthlessly pursuing evictions such that nearly a third of their tenants have been served with eviction notices. So thank you for that example that really makes our point about hypocrisy and money and greed in the system. Also, going back to a point made by the first opposition speaker about incremental change over time, apart from a few very fairy tale-ish case studies and cherry-picked facts, we actually don't have any meaningful metrics that tell us that impact investing is making any incremental change. We don't have any standardized metrics for this claim, actually. So the incremental part or other systemic change is quite hard to prove. Moving on to points made by my brilliant colleagues who talked to you about money, green democracy, and a plethora of other concerns with impact investing, I kind of want to talk only about one point, which is power.
Before you move on to your next point, I think you might have an audio issue here. If you mute yourself and one of your colleagues on your side maybe can unmute her mic, and then maybe we can try again. Shenju, would you like to unmute yourself and then see if Tanvi can speak through your mic?
Yeah.
If you want to speak now, Tanvi.
Oh, okay. Good. Go ahead.
Yeah, Tanvi, if you would like to continue, see if we've solved the problem.
Yeah, go ahead.
Okay, well, moving on, a few key statistics that I want you to keep in mind as we go through this. 77% of all impact investing firms are set in the global south, in the global north, but 59% of all investing firms invest in the global south. And 91%, 91 do not involve any other stakeholders in the KPIs that they demand. Now, why is this a problem? Let's take an example. The UK-based firm CDC invests in farms in Malawi, and it encourages them to produce crops that have a huge export demand, such as macadamia nuts. Now, when in the past have British powers that be gone into black and brown countries, provided infrastructure in return for cash crops that are harmful to local population and environment in order to extract profits from the cheap labor opportunities and tell us that they're helping us at the same time? This sort of neo-colonial issue is very obvious to me as somebody coming from the global south, but perhaps there's no way for people in the global north, for these firms based in the global north to know that, since they do not collaborate with local partners in the places they're investing in order to set goals or make these plans. And their boards, well, only about 6.5% of social investing directors in the UK are ethnic minorities, where the population is actually double that. This is honestly an example of a much larger systemic issue. Today, we want you to pay attention to the systemic part of the motion. Given the time, the literacy, the access, the power requirements that impact investors ask of their applicants, are we not systemically privileging those who already have some amount of access? An example of this comes from sub-Saharan Africa, where relatively developed countries such as Kenya and South Africa see far more investment than nations such as Burundi or Somalia, where the need is perhaps greater. Not only are we deepening fault lines within countries, as my colleagues have illustrated, but we're also doing so between them. I think I speak for all my colleagues when I say that we don't think that impact investment is an anathema, but we do think it needs to be reimagined. By focusing on the investing part of impact investing, as in the financials, we are foregoing impact. We have to decide which side of the spectrum we want to fall on, because we do have evidence that says that the normal form of impact investing generally involves 10-year plans and a lot of pressure to create short-term returns. That as soon as you shift your focus from the financial returns to the social returns, we see an IRR go down to the -1 to 3% during the first 5 to 7 years. If we want to actually make a difference, we have to contend with ground realities as they currently exist, not as we would like them to be. To let go of our fairy tales about what this money can do, and we actually have to collaborate with people on the ground, be more accountable, and how all of impact investing is being shaped by our intentions. With that being said, I would like to thank everybody for their time and for bearing with our technical difficulties.
Thanks, Tanvi, for your concluding remarks. Now I look to Anya Johnson to conclude the whole debate.
Thank you, Chungkai, and thank you to everyone here today. So we've heard from my colleagues on the proposition side, and they've made some very good arguments. But now I'd like to summarize the very strong and quite succinct arguments that have been made by my opposition colleagues. But before I touch on those points, what I'd like to do is recalibrate the audience here back to the core of our discussion today. And so what I would implore the leaders, the academics, all those who are here virtually to discuss, listen, and really engage in this dialogue is to truly consider both sides, particularly because the argument today is not just about impact investing and whether it reinforces or does not reinforce unjust systems. Today, I hope you're thinking about the unjust system, because what we're trying to debate here is to better understand the best way to move forward given the constant that is the unjust system. And so on the opposition side here, we believe that the best way to move forward is to truly be realistic and pragmatic about our reality. And for that reason, my colleagues' arguments reinforcing the time constraint that we're engaged in around on this topic makes a very strong a point here. And particularly because there's a need for impact investing now. There's a need to create and sustain momentum within the global capital markets now, why measurement is happening and needs to continue to happen now. All of this is because there's an immediacy present, and we cannot wait for the unjust system or point fingers at it or wait for it to fail or try and reconstruct it from scratch. We've got to use simply what we have. And what we do have is a particularly sharp tool in our toolbox, and that is what we believe impact investing can do. Now, impact investing isn't going to save the world. Traditional investing isn't going to save the world. These are simply tools that we can use to help move progress forward, smaller wins for the greater good for the longer term. And so fundamentally, in this argument of not waiting to fix the system, but really thinking about how to navigate it, how to instigate change inside, my colleagues have evidenced how impact investing can truly create positive impact for stakeholders and also to create positive impact on the system itself. And I don't have to spend too much time on this because it's happening today and we're seeing it today. In fact, the reason why we're all here is because others before us, others in the space today, have instigated change to the system whereby we are here in this space having a conversation on the importance of impact investing for our future. We see it in institutional investors and asset allocators around the world who understand this, and many are driving the shift towards capital allocation and have been for the last decade. In fact, now many of the largest institutional plans across the world are thinking about how to integrate impact investing into their core portfolio, not as a niche or specialty allocation. They've challenged the system and its actors to think about impact measurement and using it as a tool for return and impact to better strengthen that portfolio. Impact investing has also helped to innovate capital market instruments. Stanford produced a report noting the resurgence of new types of bonds being issued, those linked to social outcomes, which have actually recently been launched by the Ford Foundation. We've seen SPACs structured to support SDGs. In 2011, less than 1% of impact investments reported went to publicly listed instruments. JP Morgan and Jen, who ran this survey, 10 years later followed up. And in 2020, that same survey showed publicly traded debt making up 24% of the impact capital invested and public equity making up 10%. This is money in motion. This is exactly how you change the system. And when we take a step back and we look at what's happening in the private markets, when we think about private equity, Baines noted that LPs in this space, thinking about ESG, in their survey, 88% said that they would use, and they do use, ESG performance indicators when making investment decisions. And in fact, 87% of LPs they surveyed said that they invest in companies that have reduced the near-term return on capital so that they can reallocate that money to ESG initiatives. So when we think about what impact investing can do, we need to think about what it has been able to do. And it has been able to push the system forward. It has been able to create a system that was very much unjust, even more so years and years ago, centuries ago. And we are now seeing a shift and a pivot in the marketplace where the system is being held accountable, where we are holding all stakeholders for change. And we're seeing this being benefited for communities who reap the benefits of impact investing in affordable housing into neighborhoods, to more entrepreneurs of color, more entrepreneurs of diverse backgrounds, to more investment managers of diverse backgrounds, launching and going into places where capital was typically not allocated. Impact investing is just one part of this puzzle. And I know that our proposition colleagues made a statement around measurement and not being able to see what the social impact is, because we throw a lot of facts around, as I just have, on the financial metrics, the financial returns. But the reality is that is what's happening in the space today. There are so many impact measurement efforts happening. There are, SDGs happening across every company. Almost every company has them listed. We've got GIN and their reports that happen, and they're continuing to build out their measurement platforms. And it's not really about having one metric that's standardized across the entire universe. It's about having small different metrics that are specific to the investments that are being made for specific communities. So in conclusion, really at the end of the day, what we're thinking about is how do we find innovative ways to mobilize more capital? Because that's what really moves progress fast. And we know that and we see that. We have seen what capital can do in the right places, but it's about moving the right capital to the right place at the right time. It's about using that as a way to push against and challenge the system. And quite frankly, to vote in favor of the opposition is to vote in favor of the progress that we are seeing today. And it's to vote in favor of accelerating that progress by continuing to challenge and put pressure on the existing systems. And so with that, we believe impact investing is a fundamental part of our financial futures, not because it should be or because it has to be, because it has to be to help support the global collective efforts to create meaningful change by disrupting the system from the inside. Thank you.
Thank you, our last debater, for concluding the whole debate. To close the debate, I just want to thank all the debaters for their wonderful, fantastic speeches, and for all the audience members who engaged so much with the debate. And I would like to hand over my chair to Amanda. Thank you.
Thank you so much, Chengai, and thank you to all of our brilliant debaters this evening. We'd like to invite you to respond now to the second poll that you should see on your platform. Now that you've heard the arguments on both sides, please take a moment to respond. And to close out our forum over the last 3 days, I just wanted to take a moment to thank you for being here. Thank you for taking this journey with us at the Oxford Economics of Mutuality Forum. No matter what role you play in our society, we hope that you took away new insights, met more like-minded colleagues, and learned about pathways to put purpose into practice. You can join the community for ongoing conversations and to learn about tools and resources to support responsible business by joining the Economics of Mutuality Conversations LinkedIn group. And if you want to learn more about the brand new purpose scanner that Nadia debuted just a few moments ago, or read the research and case studies about implementing Economics of Mutuality over the last 15 years, visit the Discover tab on the event platform for more information. Thank you for your commitment to responsible business, to finding mutual strategies, and to building cultures that will accelerate the next era of capitalism. Together, we can build a world that works for everyone. Onward, my friends, and thank you for joining us.